Hello, hello. Good morning. Let's make sure you can all hear. Let me know if the music stopped. Good morning, everyone. I see you coming in. Good morning if you're in California, 9 a.m. Let's make sure the chat is working. Good morning, Ant. Good morning, Sandra. We have Leanne. We have Rolf. Good morning. If you want to write a couple of things in the chat to make sure the chat is working. Here, just let us know where you're coming from. We have a very diverse crowd all over the United States. So, hey, from Colorado, from Texas, I hope you guys are doing good. San Diego, Virginia, good morning, North Carolina. Buenos dias to you, Don. We'll say good morning, Atlanta. So today I want to say thank you for joining. My name is Laura. If we haven't met, Laura DeHanes, with my CPA Pro. And today I really wanted to do something really special for our people and our business owners. We specifically work with business owners, and we had these questions come up a lot in the last, I would say, 12 to 18 months. And the questions are coming from a couple of different points. It's coming from the point of what is this crazy Bitcoin up and down? We're running a business. We don't have time for Bitcoin. Yet it keeps following us and it keeps showing up in the news. And I think the fear of missing out on investments and the fear of missing out on what's happening on the gains, the losses, all the conversations that go around Bitcoin, I feel like it's making people feel like, hey, we're missing out in the business owner world. So what we wanted to do is to really have a really special event, really to educate our small business owners that make, a million, 5 million plus in income and in revenue, that so they can open up and diversify their portfolios. And how do you do this tax efficiently? I think this is the biggest question. And what's the relationship? Does Bitcoin have anything to do with tax? So today we have an amazing lineup of speakers who will really educate you on different pieces of Bitcoin and the journey from, understanding what the currency really is, from mining down going into how do we invest tax advantageously, right? And then we're going to go a little bit more into tax conversation. So today we will have a Q&A session at the end. And if you put your questions in the chat or if you put your questions in the Q&A section, we will pick them up at the end and we'll kind of go with the flow and see how this is. And Cynthia here, she put the agenda in the chat for you. So the first conversation will be with James Slavish and we'll go over Bitcoin 101. So I want to welcome all of you. Have your coffee, have your tea. Your matcha, whatever works for you. Let's have some fun. And I want to present to you, James, if you are up here, I really want to get started right away with the Bitcoin 101. And some of you might already know James Lavish, who is all over the place lately, and I love to see you all over the news. The author of The Informationist on Substack, a weekly newsletter that simplifies one financial concept for you weekly. So I encourage you to be part of the newsletter. Right now, they have over 40,000 subscribers. Great, great content. James also has over 25 years of institutional investing experience, and he is a managing partner of the Bitcoin Opportunity Fund. And you'll ask what that is, and I encourage you to ask questions. He's really good at answering that. And the Bitcoin Opportunity Fund is a partnership that makes public and private investment in Bitcoin ecosystem. And you might ask what that is, which I encourage you to ask James. James, thank you so much for being here and giving us the Bitcoin 101. I love your approach and the way you explain it. So I hope all of you enjoy. James, welcome, welcome.
Thank you, Laura. Thank you, Cynthia. It's good to be here. And I think what I'm going to do is give people a kind of a really high level, 100,000 foot view of why Bitcoin, especially as an investment, and why it's so important in the world we live in today. And so I gave a keynote speech at a gold conference a few months ago, and so. Gold and Bitcoin are really similar in a lot of ways. And we're going to talk about that today. But Cynthia saw that presentation, and we thought it'd be a good idea to kind of adjust a little bit, update it, and show you the same thing, because I haven't presented this publicly otherwise. And so this might be interesting for you. But if I can do what I need to do here technology wise, which is always a challenge, but we'll try it. And then I will let's see. And here's the issue. Let me put this over here. And then I'm going to show you the presentation, and we'll kind of walk through what I'm talking about here. And I'll get close to the microphone. Right. I think it's this. Okay. Can you all see that? I hope. All right.
That's
Okay.
great. You can all see it.
You can all see it? Okay, great. So as Laura said, I'm the co-managing partner of the Bitcoin Opportunity Fund, and that's a hedge fund that invests in the Bitcoin ecosystem and the Bitcoin space. And unlike typical VCs in the space, our core focus is on companies that are more mature. We like to say real companies generating real revenues and creating real profits. So we invest a lot in the public space. And then we also do some private things too. Some VC stuff, some early stage, but really most of it is further down the line, more mature. But I'm not going to talk about the fund much here today, but we did just launch the second fund, Fund 2. So if that sounds of interest to you, you can find out more at bitcoinopportunity.fund. Just put in your info, and we can set up a call, or we can send you information, or whatever you want. So, but let's just dive into Bitcoin and why we think it is so important in this world that we live in. So, as you may or may not have realized recently, the world is turning digital, and it is getting cheaper. It should be. So from books to photographs to how we move around the world, every single analog business has been or is currently being disrupted. And these are deflationary forces, ones that have created abundance for a lower cost. I mean, as an example, when I was a kid, for some of you people who are closer to my age, you may remember walking on Strawberries or Tower Records, and with that 12 to 15 bucks that you saved up from your newspaper route, just to buy one single cassette tape or CD with eight or maybe 12 songs on it, or maybe a $5 ticket to the new Star Wars or James Bond movie. And now I get millions of songs streamed immediately through Spotify, and for 12 bucks a month, I can get thousands of photos and store them in the cloud for just a few dollars a month. And I get thousands of movies at my fingertips on Netflix without ads for 15 bucks a month. So why is the cost of everything still seem to be going up? Everything else? Well, it's pretty simple. At a high level, And in essence, the world is addicted to debt. It all has to do with debt. And so just a few years ago in 2020, we shut down the global economy, just ceased virtually all productivity, and debt skyrocketed. And it was up 50%. It's up 50% in the last 8 years. Even here in the US, where we have the global reserve currency, the US dollar, and the global reserve asset of the US Treasury, we have the same problem. And it wasn't just the COVID lockdowns. This has been a problem for decades, 5 decades, actually, since we got off the gold standard. Debt and borrowing in the US has skyrocketed. And why not? There's literally nothing holding us back from borrowing ex infinitum. The debt ceiling is more like a suggestion now than a limit. Both parties break right through it every couple of years. And right now, we don't really even have one. It was postponed, and it's just now at the highest level that it was previous. So right now, our debt limit is where our debt ceased on January 1st. So it's like $36.1 trillion. And so now what we're doing is we're just spending money out of the Treasury general account, which is like the checking account for the Treasury, while we wait for Congress to get themselves together and figure out what the new debt ceiling is going to be. But it doesn't matter which party's in power. It doesn't matter what year it is. The debt ceiling is raised constantly. And so, but before we demonize debt, let's realize that borrowing can be useful and important, as it allows you to just pull future productivity into the present if used responsibly. But the US has not been responsible. You see the problem here? With each incremental unit of borrowing, we're generating fewer units of productivity or total US revenue since 1971. And this really exploded after the great financial crisis. And like I said, it's not just the US, it's a debt disease across the world. Any country that issues debt in its own currency will never hard default. Why would they? Instead, they'll soft default. And that's through high perpetual inflation, a phenomenon primarily caused by the expansion of the money supply. And you might say, that's fine. Investors will turn to the US Treasury, the ultimate flight to safety asset, in order to protect themselves, protect themselves against this inflation. But the Fed is a major driver of global M2 expansion. Through quantitative easing, the Fed printing money and dumping it into the open markets, and other fancy programs hidden behind acronyms like BTFP, the Bank Term Funding Program that you heard about when Silicon Valley Bank collapsed. Well, this is saving select banks from bank runs in times of stress. The reality is we must keep printing money. We must have inflation to increase nominal GDP, to increase the tax base, to perpetuate the debt charade. In every crisis now, the Fed and the Treasury print money, expand the money supply, and cause asset inflation. And what happens in the next crisis? We may see QE infinity. The bottom line is Yellen knows it. Powell and other Fed officials have admitted it. And now Bessent he understands it. But we are on an unsustainable fiscal path. So this chart here shows the debt to GDP rising exponentially as expected by the Treasury. This is their chart. Their study produced it. It was a study by the Treasury for Congress as they published the world to see this a little over a year ago. It's been removed from the website since, but they showed this to the whole world. And it was literally subtitled An Unsustainable Fiscal Path. Okay, so a little bit of math here. Don't panic. I'll simplify it as we go. But take a peek at this chart put out by the US Treasury itself this past month. Or actually this past cycle. So the US, remember, is on a October fiscal. So October 1 is, this is actually wrong. October 1 is the end of the fiscal year, September 30th. So October 1 is when it start. So this is a full year of 2024. All right. So if you look at the river flow of funds from the pocket of Americans to the expenses of the US government over the course of the year, what do you notice? Well, first, the total receipts from taxes and fees, et cetera, are $4.9 trillion. And the total outlays, the expenses, are $6.8 trillion. That's a deficit of $1.9 trillion. Lovely. So we also notice that the five largest expense items are Social Security, health, Medicaid, interest, Medicare, and defense spending. And these total $5 trillion. Oops. So here's the problem. Mandatory expenses these are signed into legislation. They have to be paid. There's Social Security, Medicare, Medicaid, and things like unemployment. There's also interest on our debt, which we must keep paying or we'll default. And these are mandatory expenses that already soak up all the tax revenue and then some. But then when you add in discretionary expenses, the total is actually $6.8 trillion for that $1.9 trillion deficit. So you don't have to be a math genius to figure out that this doesn't add up. Well, okay, so there are three possible solutions though. And we hear about the fight politically all the time about these solutions, and people get pretty emotional about it. First of all, you can raise taxes. Well, that's not going to happen with Trump. And actually, if you've ever seen a Laffer curve, there's only so much you can raise taxes until you get to the point where you start hampering productivity, and productivity leaves the region, and you start getting less tax revenue as a country. All right, so that's the first thing, and that's just not going to happen right now. Trump is looking to lower taxes. Okay, the second thing you do is austerity. We can cut expenses, which is actually political suicide. Each party tries to trick the other party into doing it, but neither party ever wants to fall into this trap. So nobody wants to cut expenses. But I know it. I hear what you're thinking. There's a new dog in town. And Trump and Musk want to cut away the fat, and they've found plenty. They've cut about $200 billion of fat so far annually. But to get to surplus, they'd have to cut into muscle and bone. I mean, it sounds great, but again, here's the reality. It is not going to happen. We're not going to get into surplus, at least not this year. And I would highly doubt we get into surplus in the next 4 years on real productivity. And we're going to get to what that means in a second. But the reality is the government spends too much. We can't even cover our interest expense. If the US government was in other words, we pay out what we have to on our mandatory expenses. And then the next thing that we have to pay is our interest expense, or we're going to default. So, but we can't even cover that with our income. So if the US government was a company on the New York Stock Exchange, it would be considered what we call a zombie company, dead man walking. So even if we cut out defense and all other spending entirely, we're still in deficit. We have to borrow to pay what we owe. So borrow more to pay what we owe in the past. So what do? Well, that's the third option. We'll continue to issue more debt to finance the deficits. So the bottom line is deficits leads to borrowing, leads to higher interest expense, leads to higher deficits, leads to more borrowing, and even higher deficits. And this is what's called the debt spiral. We're already in it, and it's going to be a very difficult path to get out, where all roads right now lead to inflation. And investors are starting to look for safe havens. You've seen gold take off, and we're going to talk about that and some other things right now. But investors have typically used US Treasuries to hide, the ultimate safe haven, or at least it used to be. And then this happened 2 years ago. So who wants to own these now? A severe rise in yields caused this, and it can happen again. So investors must consider the problem that the Treasury and all central banks have. Central banks must allow perpetual high inflation. And even if they kind of hide it through Bureau of Labor Statistics or other studies saying that inflation is only 2.5 or 2.8%, The reality is inflation's much more closely tied to the expansion of the money supply, which you saw earlier is over 7%. So at some point, though, they lose control, all of them, and the bond vigilantes take over. And this is what happened in this last fall. Some argue that the bond vigilantes are already here. The Fed has all but lost control of the long end of the curve. They don't really have control over treasury prices. They control the Fed fund rate, which is overnight rate, and everything's kind of keyed off of that. But when they so after lowering the Fed funds rate by a full percent, the 10-year bonds, the 10-year yields have risen by the same amount. Why? Well, the bond market expects long-term inflation in the form of either an overheating economy or a response to a drawdown, which would mean excess liquidity, more QE, or some other monetary expansion. Either that, and they expect a massive amount of US Treasuries coming to the market from growing deficits, which leads to inflation. So how do you protect yourself? Where do you hide? Equities are risk assets. Bonds can have large interest rate and duration risk, as we just saw. Cash just melts away versus negative real rates of return, as we've all experienced. And many investors, many of you, have turned to gold, which has been good. You've heard the saying that Bitcoin is digital gold, but let's drill a little bit deeper on that. So grab a cup of coffee and let's settle in for a moment. And some of my newsletter readers will recognize that. But the reality is that the gold is analog money. Bitcoin is becoming digital money. And as of now, it's digital capital. Neither gold or Bitcoin should be dismissed. They're not mutually exclusive. They have different benefits and risks. Both are scarce assets and sound money, but Bitcoin has emerged in this quickly digitizing financial world. As Michael Saylor often says, think of Bitcoin as digital property in an extremely limited neighborhood. Now, you hear all kinds of words describing Bitcoin, like decentralized, immutable, divisible, portable, scarce. If you've been resistant to learning about or accepting Bitcoin as a legitimate asset, I urge you to reconsider. All right, so let's now do a simple 101 on these, and I'll make it quick. First, Bitcoin is decentralized. What does that mean? It means it's governed by tens of thousands of nodes, fully distributed across the world. These nodes are basically, they keep track of the Bitcoin ledger. They keep track of all the transactions that have ever taken place on the Bitcoin ledger. That's called the blockchain. They have a record of it. It's not very big. It doesn't take up much space. It's very easy to check very quickly. So this fully distributed ledger makes Bitcoin's protocol highly tamper resistant. So Bitcoin has no central authority. This network of nodes validates and records all transactions, and they keep each other in check. Decentralization ensures that there's no single failure point. So no entity, be it a government, bank, corporation, or individual, can control or manipulate the system. All transactions settle on a transparent, open network. So Bitcoin is immutable. What does that mean? It means it's secured by the most powerful computer network that spans the world and is rapidly growing stronger. With proof of work mining, that's the protocol that Bitcoin is on. The Bitcoin network's annual energy consumption is 175 terawatt hours per year. That's the equivalent of 20 nuclear reactors running continuously. Now, this prevents the network from being attacked or compromised. It's more energy than that of Ireland, Denmark, Greece, Portugal, Hungary, Switzerland, Czech Republic, Belgium, Finland, Austria, Norway, and many others. The Bitcoin network has operated continuously since 2013, where they had a 10-minute hiccup, but it was resolved, and it has been operating continuously since that moment and processed over 1.1 billion transactions, maintaining more than 11 years of uninterrupted service. Put simply, the Bitcoin network is a fortress of digital power that's nation-state level resistant and growing stronger every day. You also may have heard that Bitcoin is infinitely divisible or nearly infinitely divisible. So each Bitcoin is divisible into 100 million parts called Satoshis, so everyone can use it. It's able to handle hundreds of billions of microtransactions every day. So don't confuse infinitely divisible with infinite supply. Just like a dollar can be split into 100 pennies or a pizza can be cut into 8 or 12 slices, the dollar and the pizza don't get any bigger, and neither does each Bitcoin. Now, Bitcoin is portable. Bitcoin is borderless, and it can be sent or received anywhere in the world at any time within minutes. Unlike physical money or gold, which are cumbersome to transport, Bitcoin's digital nature makes it highly portable. You've all seen the photos and videos of gold and cash being confiscated at the border of hostile countries. I can have $1 million, $1 billion, or more. All I need is to memorize my 12 words, my keys to take Bitcoin with me anywhere in the world. I'm actually not even taking it with me. I'm just accessing it. It's already everywhere in the world on this Bitcoin cloud. I just have to access it. This feature, though, makes it an ideal global currency, especially for cross-border payments or financial inclusion in remote regions. And Bitcoin is scarce. With a hard cap of 21 million Bitcoin that will ever be created, Bitcoin is truly limited in supply. So do the math. There are over 60 million millionaires in the world. Only 1/3 of them can ever own a full Bitcoin. So in short, Bitcoin is deflationary. It's a deflationary asset that cannot be debased like fiat currencies. This is why you often hear Bitcoin described as digital gold and a hedge against inflation. But in this way, it's even better. And Bitcoin is catching on, slowly, but significantly. All right, even though you may have seen Bitcoin recently crested all-time highs over 100,000, we're still super early in the Bitcoin adoption phase. If you look at all of the investable assets in the world, there's $900 trillion worth of them. And these are places that investors are seeking to keep up with or beat inflation. Now, Bitcoin at its peak here was about $2 trillion, a little bit less than that now. It's about 1.8. But Bitcoin is still only 0.2% of that. That said, Bitcoin's been around for thousands of years and gold has been around for thousands of years, excuse me, and Bitcoin is already 1/10 of its size in just 15 years. So some quick math. At 1% of total global assets, Bitcoin is a $9 trillion asset and worth about $450,000 per coin. At 3% of total global assets, Bitcoin is worth over $1.3 million per coin. So no, make no mistake though, adoption is accelerating, even though it's volatile. And there have been some major catalysts to drive that adoption, and there will be more soon. One of the biggest catalysts that we've seen is the introduction of the Bitcoin spot ETFs. Bitcoin is now becoming a strategic asset. BlackRock, Fidelity, Bitwise, and others have ushered Bitcoin in as a separate asset class for investors to add to their portfolios through the ETFs. And investors have been devouring them. BlackRock's ETF, IBIT, is the fastest growing ETF in history, getting to $40 billion, 6 times faster than the previous 3 fastest. IBIT's now in the top 1% of all ETFs in size. And in just over a year, it's bigger than any ETF launched in the past 10 years. And there were 2,800 of them. It's worth noting that Bitcoin ETFs are spot ETFs, just like some gold ETFs, but the difference is that Bitcoin ETFs' underlying holdings are extremely easy to audit and verify. In contrast, it can be difficult to audit and verify precious metal ETFs. JP Morgan held over 1,000 counterfeit gold bars, supposedly worth over $50 million in their vaults. Now, I worry about this with my own gold and silver ETFs that I own. But with the Bitcoin ETFs, every penny all can be easily audited and verified on chain. There's no need to go into vaults all over the world and to test it physically. One of the catalysts are the options on the ETFs, which were recently approved by the SEC. And these monthly contracts started trading recently, and actually we have more than monthly now. But these are important to the investing community and provide the ability for effective risk management, particularly for hedge funds, family offices, and proprietary books for their own liquidity and exposures. Another big catalyst was the FASB ruling. So a little over a year ago, the FASB issued a ruling which addressed the accounting for companies that own and hold Bitcoin. Some of you tax experts would know this. But the new guidance requires entities to measure certain Bitcoin at fair value, which changes its fair value recorded in net income in each reporting period. So the old rule was if you bought Bitcoin and you held it on your balance sheet, you would have to mark it at either the cost or the lowest value that it has traded to, and then hold it there at that lowest value, the lower of either cost or that lowest value, and it would be treated as an impaired asset. Now, the new rule says you treat it as fair market value, wherever it is in the market, mark to market. So if you buy it at 80,000, it went down to 40,000. Instead of having to hold it at 40,000, you could now, and it goes back up to 80,000, you can mark it back up at 80,000. Prior to this, you had to sell it to actually get that mark back up. So these amendments just went effective, and they're a big deal for companies who have been looking at Bitcoin to be added to their balance sheet, but have been worried about this impairment. All right, so you probably have heard that the US adopted a Bitcoin strategic reserve. I mean, the political landscape has changed dramatically. And Trump just created that Bitcoin strategic reserve through an executive order. It's widely expected that, well, first, this is where the U.S. can add to the reserve through seizures of illicit or illegal activities. And there's no function to add to Bitcoin just by buying it outright with U.S. Treasury dollars. But there is a provision to add to the Bitcoin reserve if it's budget neutral. Well, how would they do that? Well, one of the things that that Trump did with this executive order is he also created a digital asset stockpile. And that digital asset stockpile would be things like Cardano, ETH, Ethereum, XRP, and other cryptocurrencies that they've seized in illicit or illegal activities as well. But there's no provision to add to those at all. So an easy thing would be for the government to be selling those and buying Bitcoin with those dollars. But over the last 10 years, the government sold about just under $200 billion worth of Bitcoin. They still hold 200 billion, apparently, and but they're going to hold that now. That is signed into the order for the strategic reserve to hold those. The second thing you may have heard of is the Bitcoin Act, and that came from Senator Lummis from Wyoming, and it's widely expected that the Bitcoin Act, which was reintroduced to the Senate this last week and spearheaded by Senator Lummis, who now has multiple co-sponsors, it's widely expected this is going to start moving forward. Now, this act, this is calling for the U.S. government to buy 200,000 Bitcoin per year for the next 5 years for a total of 1 million Bitcoin. That's 5% of the total Bitcoin supply and would roughly mirror the size and scope of the U.S. gold reserves. So if none of these catalysts convince you, though, then pure performance of Bitcoin to date should. Let's look at Bitcoin priced against other investment assets over the last decade. Here's Bitcoin versus U.S. Treasuries. First, Bitcoin has outperformed every asset class in the last decade. The Treasuries is kind of a layup. But from being priced at roughly 0.1% of the index 10 years ago, Bitcoin's now worth over 25x that now. So do the math. It's devastating for bondholders. Gold is a similar story. Bitcoin has gone from being priced at roughly 0.3 times an ounce of gold to 27 ounces. Yes, it's been volatile, but it's volatility in a rising asset. All right, so what about risk assets? Here's BTC priced in the S&P 500 total return index, including dividends. Bitcoin has gone from being priced at 0.1 of the index to over 6.7 times it. And for those wondering about the high flyers, the ones driving all that S&P performance, here's Bitcoin versus the Mag 7. Bitcoin has gone from being priced at roughly a quarter of the Mag 7 total return to 3.6 times that now. All right, so that's great, you say, but look at that volatility. It must kill your returns, right? Actually, no. Quite the opposite, in fact. Here's Bitcoin over the last 5 years. This is what happens when you take Bitcoin and you add it to your typical 60-40 equity bond portfolio. Right? So if you have just 60-40 portfolio, that's that brightest blue line at the bottom of the chart here. And this is as of the end of last year, by the way. So, but if you look at this, if you look at Bitcoin and you add just 1% to your portfolio, you can see that next blue line above, it augments your returns by a few percent. If you add 5%, it doubles your returns. If you have 10%, it quadruples your returns. If you had 10% allocation to your 60-40 portfolio. And this is in a major drawdown here and sideways activity. That's from the all-time high in 2021, 22, all the way down, back down to when Bitcoin was down at 18, 19,000, and then all the way back up again. So what about the volatility though? The huge drawdowns must crush your Sharpe ratio, right? Well, again, if you look at the returns of Bitcoin over the last 10 years, and that same exercise where you add it to your 60-40 portfolio, there's a lot of numbers here, but we're just going to key on a few of them. If you added Bitcoin, and this, remember, this is actually just right before and as the Bitcoin was rising in the election. So this would be even better than this. So key points here. Adding 1% of your Bitcoin to your portfolio raises your annual return by over 1%, your annualized return. But it only increased your volatility by 5 basis points. But it increased your Sharpe ratio, and that's your risk-adjusted return, adding only just 0.23% to your largest drawdown. So what's the Sharpe ratio? The Sharpe ratio is basically says your returns with your volatility. And so if you have a high volatility and okay returns, you have a low Sharpe ratio. If you have low volatility and great returns, you have a high Sharpe ratio. So you have to have phenomenal returns if you have high volatility in order to have a higher Sharpe ratio, which is what you have here. Bitcoin's returns are so phenomenal that your Sharpe ratio goes up whether you add 1%, 5%, or 10%. And if you add 5%, your Sharpe ratio actually jumps up over that magic 1.0. If you add 10%, your Sharpe ratio jumps even higher to 1.28%. And that's with only a 5% higher drawdown in your worst market. So in a word, it becomes compelling. So let me leave you with this. This is a chart from last year, remember? So this doesn't even include 2024. This is one that was created by investment bankers. And I think it was put out by Bloomberg and Morningstar. So in the last 12 years, Bitcoin was the best performer out of 9 out of the last 12. And so it's slowly but surely moving out of the risk to own category and firmly into the risk to not own category, especially for money managers and institutional investors. Let's put it this way. I wouldn't want to have to explain to my clients and LPs why we didn't own any. And thankfully, not a conversation I'll ever have to have. And I hope that you don't either. That's it.
Thank you so much, James. That was so good. And this was amazing. I see there's a lot of questions,
Mhm.
and probably a lot of it had to do with the terminology. And the insights were amazing. We do have a few minutes.
Sure.
I know James mentioned we said at the beginning that we will have a Q&A session at the end, and I encourage everybody to come and bring in their questions for the end. If that's okay with you, maybe we can answer a couple of questions now, since James will not be able to join us in the Q&A session later, just before Eric comes up. So, is it okay if we go over a couple of questions?
Yeah, let's go.
Yeah,
Let's do it
that
now.
was
Yeah.
amazing. And you touched the point that I think is so crucial. For my business owners, I think the balance sheet is the piece because we find a lot of the business owners have cash, and they're sitting on their cash and they just don't know what to do with the cash.
Mhm.
How do you hedge against inflation? I think you touched a couple of points that are really, really good. So let's go through some questions. Um, I see Andy. I'll just go from the bottom because I there's a lot of them. Um,
Mhm.
let's see. They ask about the Sharpe ratio. Cynthia, if you can help me out, point some of the questions um, here that were coming in. Eric came in with the multi-sig storage, great for those with memory issues. They asked about huddle. If you want to talk about that for a moment.
Oh yeah, so HODL. That's just I think it's an old cypherpunk term because back in the day somebody was messaging on one of the message boards about holding Bitcoin and he misspelled it HODL, and it just became a meme where now it's an acronym for hold on for dear life. But so Bitcoiners use HODL as their as kind of the signal to just keep holding.
Yeah, yeah, that's always interesting. So I have Jason come here. It's a comment slash question. The major problem society will run into with Bitcoin and crypto is the self-custody and human memory problem. Lots of
Mhm.
wallets with funds will be inaccessible as people forget their seeds, lose. Imagine being 63 now and holding for 20 years. Will you remember where you put your super
Yeah.
secure seed phrase at 83?
It's a great question. And okay, a few things. So number one, man, the Bitcoin is daunting to try to buy and hold and put into cold storage and put in a wallet and all that stuff. When it scared the living daylights out of me. And I mean, I've wired hundreds of millions of dollars before and billions of dollars, probably $100 billion over the course of my career. And I was kind of nervous each wire, but moving just a few $1,000s of Bitcoin, it was really nerve-wracking. So I agree with you, and that has to the user interface has to improve there, and it will. Um, but a few things. Number one, the ETFs make it super easy for you to buy Bitcoin, where you actually do own the underlying Bitcoin just on the New York Stock Exchange and BlackRock and Fidelity or whoever is holding it for you. So that makes it really easy to do that. Number one for you for yourself or for your IRA. So that's been an important development. But if you want to hold it yourself, one of the things that one of the companies that I'm invested in the Bitcoin Opportunity Fund is invested in, is AnchorWatch, and they have this solution where it's not just insurance on your Bitcoin, where no matter what happens, it includes a wrench attack where somebody comes into your home and demands you give them your seed phrase. They have this insurance product that they're backed by Lloyd's of London. It's a great insurance um, company that obviously Lloyd's of London, the biggest in the world. But that's number one. And then they have technology. AnchorWatch has technology, which is a hierarchy. It's a multi-sig solution where there's a hierarchy where if something happens, so let's say you're in your business and you own Bitcoin for your business, and you're the CEO and you've got the keys. Well, if you work with AnchorWatch, for instance, they create a separate holding for you. So you put it into storage that they help manage with you, and you have a multi-signature solution, meaning that more than one person has to sign to move it. Well, if something happens to one of those people, there's a hierarchy that automatically kicks in. So, like you're talking about, if you're 63 now and you want to hold it for 20 years, well, God forbid something happens to you and it's sitting, your wallet's sitting in your safe. Well, how does your wife, your kids get control of that? Well, in this kind of solution, it has a um, a hierarchy which kicks down to other signatories that are on that list. It's kind of like they're your descendant, they're your beneficiaries, and they inherit those keys. And so it's a really great solution, but we're going to see a lot more things like that. I think that will help people.
Thank you. And I think this kind of leads into another question. I'm not sure if we have more time for additional questions, but there's another question here. It says, why invest in Bitcoin via ETF versus directly? And I think you touched on that just a little bit.
Yeah, I mean, it's really easy. And institutions do it because they just can't buy Bitcoin, themselves. Like I've worked in hedge funds forever and private equity, and I can only imagine if I was a pension fund that wanted to buy Bitcoin directly, what kind of conversations I had to have with my chief legal officer, my general counsel, like what, who's gonna buy it? You're trading on what? Coinbase, Kraken, like, okay, well, who's gonna custody it? Or if we're gonna custody it ourselves, who has control of the keys? Like, what if you lose those keys? There's just too much personal and fiduciary risk there. So with the ETFs, they can easily just buy it. It just makes it super easy. Just buy it, just like any other stock. You can, with institutions, they buy it through their prime broker, and they custody it with the same bank and pay for it the same way. They have similar margin agreements on them, and they know exactly what that looks like. For an individual, it's the same thing. You just go on to your Fidelity account, you pull up the FBTC, and you can buy it right through Fidelity, and it makes it super simple. That's why would you do it? Because it makes it very easy. Why would you not do it? Well, if you're someone looking for self-sovereignty, if you're someone who wants to, have Bitcoin that you may or may not want to stay in the United States with. I mean, I look, I would never go against the tax code. I think it's a pretty dangerous thing. I've seen people in my business do that, and it doesn't end well. So it's not a worry I have, the self-sovereignty thing. But if that is if you're very concerned about the entire system collapsing and you just want to have something that you own outside of it completely on your own, well, you can do that in Bitcoin with owning it, the real thing, not the ETFs.
Yeah, thank you so much. So, James, I appreciate that. This was amazing. And I think to summarize that, I would say, I would just consider Bitcoin. The danger right now kind of shifted on the other side of, what's the fear of missing out, not having it in your portfolio. I think it kind of shifted that the fear of Bitcoin into the fear of not having Bitcoin in your portfolio. So I think you described that very well. Thank you. That was amazing. Make sure
Yeah.
you check out the informationist and also follow James on Twitter. If I say it right, at James Lavish, right?
Mhm. That's right.
Thank you so much, James. We'll
Well,
see you around. And next up, we have Eric Rice. And Eric, let me see if you are here. Let's see if we have Eric. Uh, Now that you all got a little bit of Bitcoin 101, I want to move into understanding mining Bitcoin because that's a completely new concept. And here to explain it is another gifted educator, Eric Rice. And thank you for coming back again. Eric hosts the Rice Report, and he has been frequent guest on Voice of America. He is a co-founder and president of Sovereign Capital and brings over 2 decades of expertise in capital raising, product launches, team leadership, and predominantly in the realm of early stage ventures. Eric, thank you so much for being here. And you can take the floor on the mining. That's your field.
Absolutely.
Thank you again. Let me make you spotlight.
Yeah, thank you, Laura, and thank you, James. Please follow James. He is someone I follow very closely on Twitter. The stuff he does and the education he provides for people is unbelievable, and I've watched many people follow him and just gain a better understanding of markets. So thank you, James, for the breakdown on where we are in the marketplace and how Bitcoin fits in. Now, what we've covered so far is native currency. So it's important to understand that in this world that we're in, I'm going to share my screen here, that there are two different features of Bitcoin. There's the native currency, and then there's the network and the system and how it works. And that's what I'm hoping to break down for you here today, as soon as I get my tech lined up here. Okay, there we go. All right. So we're going to go through Bitcoin mining 101. I'm going to have some slides on here describing the marketplace itself. I think it's very important to understand is where we are in the market. Bitcoin mining is the backbone of the Bitcoin network itself. James touched on nodes, which are the governors of the system to make sure that the protocol is always in place. It's important to understand that there is a pseudonym founder, a team effort to create this. Most people, if you deep dive into the history of Bitcoin, you see all these other cryptos created for hundreds of millions, if not billions of dollars. Bitcoin was created by a bunch of freelance cypherpunks for a total of $6,800 in donations while they were coding. So we're going to go through that. And this quote I always bring up in every presentation because you can see the confusion on people's minds going from analog to digital. John Oliver, who like his show or not, this is a great quote. Bitcoin is everything people don't understand about computers combined with everything people don't understand about money. And that couldn't be a truer statement in today's world. So I'm going to give you some basics on Bitcoin mining because James did a great job breaking down the currency, the value, the market fit. But we're in a position right now where we need to understand a few different things. So Bitcoin miners I'm going to make this as very basic and as simple as humanly possible to understand. I could definitely go very nerdy and geek out on this thing and bring it into a whole world. It's important to understand Bitcoin mining from a simplicity standpoint. Bitcoin miners validate transactions. The process of validating those transactions is like quality control, and it provides security for the network. About every 10 minutes, which is not an exact science, right now it's about 9 minutes and 44 seconds, there's a new block of transactions that comes up. They compete using what's called hash rate or computational difficulty in the network, which is currently 700 as of this morning, or last night, I should say, 721 exahash. I'll explain what that term is and what it means in just a moment. It's important to understand. Essentially, these computers that you see on the right-hand side, that's an S21 Pro. These are what's called hashing machines or ASICs units. They have one function, and that is to try to solve complex computer problems in order to win a block. They make about 200 to 300 million guesses every 10 minutes to solve these problems. That hashing feature creates security for the system, almost like a force field around the fortress. When James was talking about the fortress of Bitcoin, it truly is a digital fortress, and the protection comes from the hashing. This is now impenetrable by AI. And the beautiful part about Bitcoin is the incentive structure. So nothing has been created on planet Earth with more fairness and incentive structures than the Bitcoin protocol by itself. The proof of work model, which I'll get into in just a moment, is a perfect setup for this. So our incentive as Bitcoin miners is to provide a hash rate to protect the system, get a block, verify transactions, and ultimately we're paid 3.125 Bitcoin per block plus fees. And it was estimated about $15 billion in revenue came into miners' hands in 2024. So Bitcoin runs on what's called a proof of work. So I am talking today about Bitcoin and not crypto. And I think that our government has done a brilliant job so far, really separating the difference between Bitcoin, which has no CEO, no board of directors, no venture capitalists, no fingers in the cookie pot. And more importantly, no one has ever gotten a Bitcoin for free. So when you look at crypto, they're generally they call it pre-mining. They actually create these currencies out of thin air. They hand them off to their buddies and their investors. They create a market and they sell into the market, and essentially you're, for a period of time, exit liquidity. In Bitcoin, it's different. You have to mine it. It's all earned. Nothing is given away for free. The old saying that got me into Bitcoin, because I was a gold bug, still am, my 64-40 portfolio is 60% Bitcoin, 40% gold. And in that model, I started thinking to myself, like, why would I put money into Bitcoin and not crypto? And it's really one of basically four cryptocurrencies out there that use proof of work as a system. And if you don't mine it, it doesn't have any worth. Like, that's kind of an old feature that my grandfather taught me. Bitcoin is a meritocracy. You have to contribute to the network in order to be rewarded for Bitcoin. This is very different than proof of stake or cryptocurrencies. You have to have skin in the game. Bitcoin mining requires intensive capital to buy computer systems, facilities, energy contracts, which we're going to talk about heavily here in just a moment. But it aligns perfectly with the incentives. If I invest and I contribute, I'm rewarded ultimately, eventually, to create higher security and to maintain that true fixed scarcity through nodes and miners. Now, the mining process, which you're going to see on the right, this little illustration. On the next slide, I'm going to make it visual. I'm going to explain it to you verbally, and I'm going to show it to you visually. And it's a really cheeky illustration, but it helps people understand Bitcoin mining at its kind of very core from a simplistic standpoint. Every time a new block of transactions comes out, which is basically every 10 minutes, it comes with a very complex mathematical problem to solve. So Bitcoin miners all around the world, literally in almost every country in the world, are trying to solve a puzzle every 10 minutes. They're making hundreds of millions of guesses per second. Once one of them solves the problem, they get the block. They get to verify the transactions. And then they have to send their verification off to the nodes, who then re-verify, make a double confirmation. And once that's finally completed, the transactions are put on the blockchain and sent out of the assembly line, put on the blockchain for permanency forever. Then that's when we are paid. You can, of course, join pools, which are like unions of Bitcoin miners, and share in your hash rate as well as your incentives. But this is the best way to explain the mechanism of Bitcoin mining. So again, every 10 minutes, there's a new block. Think of it as a packaging box in an assembly line. The transactions that are occurring on the Bitcoin network are bundling up. They're going into that box, while miners throughout the world are trying to solve this complex problem. Again, that's called hashing. These miners throughout the world, ultimately, one of them becomes the winner. He's the one who solved the problem. He gets to verify the transactions within the system. That person then sends it out to all the node holders all throughout the blockchain. They verify that all the transactions are correct, and the Bitcoin miner gets paid. That's literally the most simple, simplistic, illustrated approach I can possibly give you for how a Bitcoin miner works. It really is that simple. It's a very simple process in general. Bitcoin miners, we all do the same thing. All the computers do the same thing. The difference is always going to be energy. Now, Bitcoin mines come in all shapes and sizes. So don't think of it, it's a decentralized network. So don't think of it as your traditional gold mines where you have massive industrial equipment and all these things. Bitcoin, I have 3 of these little BitAxe units that you see right there in my home. I run them every day. There's 2 in my kids' room and 1 in the living room. Those are solo miners. That's one tiny little unit that's providing very little hash rate. It's kind of like a lottery. This morning, I will say that a BitAxe unit on the left did hit a Bitcoin block for $300,000 this morning. 6 of those have occurred in the last 6 months. Home mining contributes to the network, and sometimes, very rarely, you'll be rewarded. And then there are medium-sized operations where you can see the gentleman in the center. He has 6 different mining units there. Those are much more powerful units that provide a larger hash rate and a higher probability of getting a block and verifying transactions and getting the incentive. And then you can see Core Scientific out here in Denton, Texas. I've been to this facility. It is amazing. There are 45,000 of those mining units installed in the wall with soundproofing, heat disbursement, and it's directly connected to an electrical grid. So the power feature there is absolutely unbelievable. So Bitcoin mines come in all shapes and sizes in a decentralized network. I highly advise people, everyone who invests in our fund, we send them one of these solo miners at home so that they can actually show off to their friends. And, it would be amazing if one of them hit a block. But again, it's a very low probability, but it has happened 6 times in the last 4 months. So this is a topic people often bring up every 4 years. The Bitcoin halving. What is the Bitcoin halving? Well, the Bitcoin halving is a change in incentive structure. Again, if you win a block, you verify the transactions and you place the transactions on the blockchain. Right now, you're getting 3.125 Bitcoin. That's 2024. Last year, that was 6.25. The year before was 12.5, and so on. In 2028, that will be cut in half again. But as you can see, there's a Bitcoin per block. That's the incentive for the miner to verify transactions. Bitcoin issued per day is a big thing. Right now, there are only 450 Bitcoin that are released into the open market per day, while demand is exceeding 20,000 Bitcoin. So we are rapidly approaching a supply crunch. So Bitcoin mining will become intensely valuable. And I'm going to show you who's getting involved in this space to show you the demand in the sector in just a few slides. But as you can see, every time the halving occurs, more scarcity is created in the market. There's less going into the open market and the price correlates. So we went from 900 Bitcoin per day in 2020 at an $18,000 price to 450 in the market at an $84,000 price. And I'll let your imaginations go wild as to what that will be in the future. I certainly have my projections, and they're much more conservative than other people because I would rather err on the side of caution. So energy is everything. So Bitcoin mining is essentially a big data center. You're putting together ASICs units. These are doing computational activities constantly, hundreds of millions of guesses per second at this puzzle to solve it. Energy is everything. At 121 exahash, which we've been over 1,000 exahash in the network in the past month. If you took all of the big tech companies in the world, Google, Meta, Microsoft, Amazon, Huawei, all the big companies, they would be able to equal about 3% of the hash rate of the Bitcoin network. That's because it's decentralized. Again, there are people running little small miners, 45,000 huge miners in certain areas. A decentralized network is something that human beings just simply aren't used to. We don't know what it's truly like to be in a decentralized world. But the computing power of the Bitcoin network is literally 97% more effective than all of the big tech companies combined. This hash rate creates the most secure network on Earth. It is almost impossible for anything to penetrate it. There's oftentimes quantum questions, which I'll be happy to answer later this afternoon. But as James stated, we're 175 terawatt per hour. That is the equivalent of the nation of Poland. So we are an independent, energetic nation. Bitcoin is something anyone can join. It's for everyone. And in this energetic nation, we actually have as much demand for energy as nations like Poland, Germany, and Spain. We're just below. We'll pass Germany and we'll pass Spain as far as energy consumption, which is a concern and one that should be alleviated here in just a moment. But again, as an independent, energetic nation, for us as Bitcoin miners or as investors in Bitcoin mining, it's important to understand that kilowatt per hour, I put that in there wrong, kilowatt per hour is king. Your cost of energy is your profitability. It always has been, and it always will be. And I always find this fascinating. From 1921, the New York Times, Henry Ford said that he would want to replace gold with an energy currency and stop wars. And that's a philosophical question we can get into at a later date of how fiat currencies promote war because you print it during war times. But the idea of converting energy into a currency has actually been around for well over 100 years, as illustrated in the New York Times. Now, since Bitcoin requires energy and energy costs are the profit center for a Bitcoin mine, it's important to understand that the media will tell you one thing and reality is a completely different story. Bitcoin miners are using energy in all types, shapes, forms, sizes, caliber, level, and limit to create energy currency throughout the world that can't be confiscated, can't be censored, and can never be hacked. This is an important feature in a world that's highly hackable, highly censorable, and just about every dollar you have in the bank is completely confiscatable. So energy innovations through Bitcoin miners. Bitcoin miners by themselves, myself included, there's a lot of former energy executives that are in Bitcoin mining. You will see in the future that most of our energy producers in this country, oil and gas companies, which is who we work with, are turning to Bitcoin mining for higher profit margins and to be able to use their own product in a more efficient manner. Now, I mentioned oil and gas, but 60% of all Bitcoin mining throughout the world uses renewable energy, 60%. So there's multiple types of energy contracts that you can create. You can go on grid through the electric grid. You can create what's called a PPA, a power purchase agreement, where you go to an electric grid like in Texas. It's very friendly to do this here. And essentially you buy excess energy, use it to mine Bitcoin. If the grid runs low on energy, you sell it back to the grid and create a flex load balance. Now, to give you an example of this, in 2021, when I moved from California to Texas, about 3 weeks after I moved here, we had a massive ice storm. Huge. There hadn't been snow like that here in, they said, about 50 years. And our power flickered on and off for 2 weeks. I mean, literally, it was every 45 minutes we were putting on the safety lights and flashlights and covering our behinds and making sure we could see. And 2 weeks later, it kind of faded away with the weather. 6 to 8 weeks after that, I don't know the exact date, they passed a Bitcoin mining law in Texas, and they allowed Bitcoin miners to work on grid. We have not had a power issue in Texas ever since then, and we've actually seen a very stable cost of energy. So Bitcoin miners, when you look at the traditional electric grid balance, are creating grid balance. For some of these grids are 70, 80, 100 years old. They need this flex load capability. That's one area which I find fascinating. So Bitcoin miners right now are balancing grids all throughout the United States and literally converting energy into currency. Then you have geothermal, where places like El Salvador are using geothermal energy from volcanoes. We are working with a patent company right now that's using geothermal techniques from dry oil and gas wells, where we can run a line down 10,000 feet into the surface of the earth and produce megawatts of energy for AI and things like that, of course, Bitcoin mining. Stranded flare gas, which is our strong focus right now. Traditionally, ethane, once natural gas is pulled up from underneath the surface, and I was in oil and gas for years, traditionally, you see what you see on the right-hand side. An energy company just simply burning off ethane in the air because it's volatile, it's cheap, not a lot of people have demand for ethane, and this goes wasted. This actually creates more carbon in the air than we need. If you're an environmentalist, flare gassing is a major triggering point for you. And to be honest with you, it should be. It's a waste of natural energy. But we are taking flare gas right now and not burning it off into the atmosphere and using scientific techniques and generators to be able to create megawatts of power to mine Bitcoin, high compute centers, data centers, AI, all this stuff. Guys, the one thing I can tell you from my perspective and my career experience is that computational power requires period energy, period, point blank, full stop. Without energy and a focus on energy, our nation would fall behind in other nations that have cheap energy costs and really no regulations. So the fact that Bitcoin miners have kind of led the way for the world of AI by finding new efficient manners, flare gas is a really hot topic right now in this area because environmentally it's not sound, but it can convert into massive megawatts of energy. Bitcoin miners around the world actually love wind and solar. Most industries don't. It actually has been a very slow and developing, very expensive sector of the market. Bitcoin miners are using wind and solar to mine all throughout the world, everywhere. So when grids no longer want, the flex load incapabilities of wind, they'll actually shift their power agreement to a Bitcoin miner to stay profitable. Waste energy, landfills. This is something that is mind-boggling, that people are actually going into landfills using tremendous amounts of science to generate megawatts of energy. And now nuclear is becoming a topic again and is becoming the main focal point of new nuclear builds throughout the world, including primarily Russia, that their first function of these new nuclear facilities is mining Bitcoin because it increases profitability. So we are currently the head of the tip of the spear when it comes to energy consumption, energy usage throughout the world, to be able to find new techniques, because it's pretty simple. You have all these different types of energy. You can look at on grid. If I did a PPA a power purchase agreement from a grid or an energy company, I would be paying 5 to 7 cents per kilowatt hour. It's pretty expensive. Geothermal is down to 2 cents per kilowatt hour. Stranded flare gas is around 2 or 3. If you're using tax incentives like we do, it's net negative. We're actually making money on energy and not actually using it. Wind and solar could be 3 to 4. Hydro is not listed on this slide. Hydro energy is 2.5 to 3 cents per kilowatt hour. Waste energy is 1.75 to 2.5 kilowatt per hour. And nuclear in general is less than that. And in most cases, it's being used by nation states for free. So Bitcoin miners are creating a new wave of energy usage that we haven't seen this type of innovation in energy usage in literally 50 to 60 years. So there are strategic benefits for Bitcoin mining to be allowed through countries. So yesterday, I will state this, that the SEC did approve Bitcoin mining as a non-security proof of work, contributions to a proof of work network. Non-security shouldn't have never been even considered a security, but of course our last administration wanted to shut it down for environmental purposes. They kept telling you Bitcoin uses all this energy and it's stealing your energy. 60% of our energy is from waste, energy that literally would have been thrown into a bin and never used by anyone. 60%. So there are tremendous economic incentives for Bitcoin mining and allowing legislation for Bitcoin mining. You can create new energy or new revenue generation, job creation, and of course, getting currency to the unbanked. No one has banked the unbanked in Africa and India and many of these regions throughout the world more than Bitcoin. Talk to anyone from Africa, especially Nigeria, where their currency is worth almost zero. They are using Bitcoin for transactions. It's faster, it's cheaper, and it's something they can rely on that isn't their government's money. Now, all throughout Africa, you have many regions that have never had power. They've never had running water. These are villages. Energy companies don't want to build a grid for these villages because there's no one there who can pay them. So Bitcoin miners throughout the world are constructing deals to bring electricity and running water to third world nations through Bitcoin mining. These are stories you don't hear about on the news ever. Energy utilization, stranded energy. This is a huge problem. About 30% of our energy in this country is stranded in some capability. We're releasing that type of energy, and this is needed for the upcoming AI and crypto innovations that we're seeing through the Trump administration. Renewable energy adoption. No one is using more wind and solar than Bitcoin miners, which is kind of strange because all you hear is Bitcoin's bad for the environment, but we're actually working with the environmentalists and their energy production to produce Bitcoin. And again, as I mentioned, grid stabilization. Flex load operators are required for old grids, and Bitcoin miners do it at no cost to the taxpayer. Strategic national benefits, monetary sovereignty. I'm going to get into the nation state model of Bitcoin mining very soon, but energy monetization. Again, if I'm looking forward and I have a crystal ball for the next 3 years, I'm going to say that in the next 3 to 4 years, because I'm in this every day and I talk to someone every day, I'm going to say that at least 15% of U.S. energy producers in the oil and gas space are going to be mining Bitcoin off grid on their locations using the exact same techniques that we're using in Tennessee and some other places. Geopolitical leverage, when you have this type of secured buying power, it puts your nation in a position of pure leverage when you're dealing with other nations. And as James touched upon it, cross-border payments are very simple to pay one nation for another. Currently, Russia has been buying or has been selling their oil to other countries in the BRICS nations for the last year and a half using Bitcoin. That was just released. We all suspected it for a while when we saw the oil sales coming out of Russia. People are using this because Bitcoin is uncontrollable, can't be sanctioned. It is literally its own energetic nation, fully decentralized and out of the scope of nation states and governments. And of course, it's a massive energy driver or innovation driver. When you have to get creative and lower your kilowatt per hour cost to turn a profit, entrepreneurs and scientists and very smart people get together and we do some very creative things to be able to produce megawatts of power to mine Bitcoin. We have driven the energy sector into an era of innovation that is allowing us to actually be a world leader in AI. Now, to give you an idea why I keep mentioning AI, a Google search uses a certain amount of energy. A chat GPT uses 10 times that amount. So if you're using AI and you're doing it for basic Q&A or search term, that uses 10 times the amount of energy as a Google search. So we need to be able to not only harness the capabilities of extracting energy from underneath the ground in many other ways, we need to find ways to leverage it and use it more effectively in order to compete in a modern world. So this also provides for financial inclusion, again, banking the unbanked, providing jobs in a sector that didn't exist before, and community funding. So there are many projects out there. Ours is one of them in Tennessee, where we have part of our distributions for our fund, for our firm in the fund, go to community development and funding out organizations that are doing good things in our space, in our sector, and in the areas in which we work to give back to the communities. So some examples of this that you never hear about on the news. Again, on the left, you'll see Africa, right? This is an area in Africa which was desolate, and now they have power lines and they're creating new jobs. You can see in Holland, they are using a Bitcoin mine. You can see those right now. Bitcoin mines produce tremendous amounts of heat. They are using that heat to be able to grow flowers indoors. So they have multi-purposes. Bitcoin actually is the only digital currency system that has any real-world application outside of digital. So the innovations of energy to use energy we once wasted, to lower the cost of energy, to provide it. And now you're seeing not only greenhouses growing flowers in Europe, you're also seeing people that are running Bitcoin miners in their house during the winter to heat their own home. I have actually seen people using Bitcoin miners in their kitchen to create beef jerky. So many different innovations come from this proof of work network, which everyone can be included in. And the main utility financially with Bitcoin right now is what you're going to see. James kind of alluded to this, is that it will be used as a collateral asset for insurance and reinsurance and things like that. The utilities of the Bitcoin network and what proof of work has done along with the native currency are kind of mind-boggling in just a 16-year period. So as Bitcoin mining and strategic Bitcoin reserves start to be talked about throughout the world, this is actually all part of game theory that Bitcoiners have been talking about for 10 years. You're starting to see right now, number one, the United States is approximately 35 to 40% of the hash rate. That varies from 29 to 38 roughly on a daily basis. The US has been very, very friendly in the past couple of years at allowing most of the hash rate to take place in the United States. And we want that to happen, but it's also decentralized. So we want people mining Bitcoin throughout the world. A decentralized network should never want one nation to do all the work. But you're starting to see multiple countries that are mining Bitcoin. They are literally using state-funded energy programs, and they are using that excess energy to set up Bitcoin mining operations in their own territories and produce Bitcoin for their own silent strategic reserves. This is all happening. Kazakhstan, Russia. Russia has exclusively turned on one nuclear facility specifically for mining Bitcoin. That is the primary purpose. Even Putin has said, who can stop Bitcoin? No one can. And that's because it's decentralized. Canada is getting ready for this. Bhutan is the fourth largest Bitcoin holder for a nation state in the world. Bhutan's a country you never hear about. And they have been using their state energy to mine Bitcoin for years now, just accumulating over time. And they will become a much more powerful nation for it. El Salvador is using volcanic energy. The UAE, they just put almost $500 million into the Bitcoin ETFs, and they're using their oil and gas, flare gas, like we are doing. They're doing it for 4 cents a kilowatt hour, way more expensive than we are. And we're talking to them about using our tactics. But they are mining Bitcoin. Oman, Indonesia, Ethiopia is using a ton of energy. Brazil, two of their largest energy companies, which are nationalized in these countries, are using their energy. As you can see, the pending list of countries that are doing this, we are moving from magic internet money into a truly global digital asset that is revolutionizing the way that countries are using energy, that they are regulating themselves, and they're creating profitability for their own citizens through the activity of using their wasted energy to produce money. So at Sovereign Capital, this is what we do. We have a very specialized team. We all come from either the finance, the energy sector, high computing technology, and you combine all these things together. What we do is create energy arbitrage situations. I'm not going to bore you to death by pitching you what we do, but I will give you an example of how our company is using the energy that's given to us in a specific area to create benefit not only for the Bitcoin network, but also for our investors. So it's pretty simple. In Tennessee, what we do is we have 1,500 natural gas wells throughout Tennessee and Kentucky that flow into a pipeline. This produces natural gas. There's a fractionation plant right on the site in which we work. Fractionation plants separate the anes, propane, ethane. They separate them. So we're actually purchasing the ethane from the producers right now, and we're separating it from its CO2. We take the CO2, there's another buyer on location. We're selling them the CO2 for profit. So we actually don't need to mine Bitcoin to make millions of dollars per year just selling CO2 to a company that uses it for beverages and greenhouses. So we're either helping them make better beverages, or we're helping them grow more plant life and vegetation. And that provides for us income and tax credits. So that allows us to mine Bitcoin at a sub-zero kilowatt per hour, which allows us to mine an $84,000 product for $26,500. So using what we have together with us provides us tremendous tax advantages. I'm not going to bore you through this, but each year we'll be able to produce about $3.23 million in carbon credits by utilizing this type of system. It's incredibly important that we have this diversification to be able to use the tax credits that are available to us to drive new income, lower the cost of energy, and produce more Bitcoin along with tax advantages for our clients. Now, we've also taken traditional oil. This is our site detail. You can see our whole location. We've also taken a lot of our tax strategy from the oil and gas industry. So our investors are getting about a 52.5% tax benefit right off the bat against passive income, a 25% annual return, and a 3 to 5x multiple on their invested capital. But the way I think of Bitcoin mining, because I've been a Bitcoiner for years, I got in pretty cheap, not as cheap as some people I meet. It's unbelievable how cheap they got it. But in a Bitcoin mine, the way I looked at this from my own investment in it, I invested basically 2.9 Bitcoin of today's prices to get 4.17 Bitcoin back over a period of time. And I did that at an $84 cost basis. I anticipate at least a $250,000 Bitcoin in the next 5 years. So I'm looking at basically reverse dollar cost averaging by going into a mine along with owning Bitcoin. And these are our pro forma. I'm not going to bore you with that. But I definitely want to open it up for Q&A because I think understanding the way that the mining units work is really important to understand that there is this mechanism that our miners use. You have to understand they're trying to solve a problem, verify transactions, get it approved by the nodes, put it on the blockchain, and then get paid for it, get the incentive for it. But I think it's more important to understand at the end of the day that we are in a position right now of really trying to understand the energy piece. Bitcoin mining comes completely down to Bitcoin mining energy cost. So the bridge from Bitcoin mining into the rest of the world is pretty significant. You are watching guys like us who are just interested in building Bitcoin mines at one stage of our business. That's all we wanted to do. We're getting phone calls from data centers and Amazon and, hey, can you guys do this type of energy arbitrage for us and build an AI center? So the extension of Bitcoin mining into the real world is very significant. And it's significant not just for us, it's significant for our heirs, for our children, that we're using the energy we have to make human life better all across the board. So that is what I've got for you here. Unless you want to take some questions, I'm more than happy to do so before the Q&A later today.
Yeah, thank you so much. That was great. Wow. Listen, I had no idea there's so much going into mining. And, just having basic concepts of how mining Bitcoin works is one thing. And I think you just took it to another level and exposed a lot of different questions that a business owner might have and why should you do this and why you should not. So that was great. There's just so many questions. I want to ask you a lot of questions. And then what's fascinating, as a business owner, you're always thinking about legacy. You're always thinking about your trust and how this all kind of flows. And I love that both you and James kind of alluded to the idea of, how this will literally be carried forward and I love the idea that it doesn't like you're not stopped by a specific border of a country, and then taking the legacy to the next step. I think it's amazing. So, I would love to take a lot of questions. I would love to keep this for the end of our Q&A. There's a lot of questions for you, and I think you will be having so much fun just answering the questions. I want to say thank you so much. The presentation was amazing. Everybody was asking about a lot of different questions on what you presented. So I'm excited to hear the Q&A. Now, you can all reach Eric at the Rice Report on YouTube. And you can also check out Sovereign Capital if you want to learn more about investing in Bitcoin mining. Like, I am interested, right? As a business owner, like, there's just so many different things that you could do and how you can leverage this. So I'm excited to see the questions at the end. And I want to say thank you. I want to keep going forward and I want to encourage all of you. I know it's tough to have this conversation. There's just heavy language from all over. The Bitcoin is not an easy undertaking, and I understand that. What I want to encourage you is to just drop the questions in the chat. At the end, we just have a couple more, we have a couple speakers here next, and we will take the questions. And here, like the reason why we're here today is purely for education. I want you to ask your questions. I don't want you to go home or you're at home. I don't want you to leave this event with all the questions, the unanswered concerns that you have, so we can go and see, can we answer those questions today? So I want to do that. I also want to mention really quick that, my journey here is to make sure that you get your education, and that's the purpose why we're doing this. Next week we also have an event about asset protection. All the conversations we have, it's about adding a new asset on your portfolio, which Bitcoin is asset. And if you're interested in asset protection, we have another free educational event. It's just 1 hour next week, just about asset protection. So if you're adding this to your portfolio of existing assets, just join that. Join us next week as well. So we're going to go forward now for something that I think it's one of the absolute best hidden and best kept hidden secrets in the IRA world. And many of you are familiar with the 401ks and the IRAs. But today I've got Corey DeHarsh here to explain how you can use money from your 401k or the IRA that you have to invest in Bitcoin funds, and many other types of investments. Now, I don't know about mining. That's going to be a question for Corey. So Corey, if you're on, here, this is probably one of my favorite topics, and I'll share a little bit more with you about how this topic will, kind of impacts the business owner. And, I am very excited that Corey will come in and explain this to all of you. Corey, I don't know if you are in.
Yeah, Laura, I'm here. It's not allowing me to share my video. It's telling me that the host disabled. Okay, there. Now it popped up.
Yeah.
There we go.
Good. Well, Corey, take it away. This is an exciting topic, so I can't wait to listen to the background here.
Awesome. Well, thank you very much for having me. Again, my name's Corey DeHarsh. I'm here from Advanta IRA, and what I'm here to talk about is the broad scope of how you can use a self-directed account to invest into assets like cryptocurrency. I'm not going to get into some of the more niche technical side of crypto investing. I'm not an expert in that. That's why we have other great guest speakers like you've already heard from today. I'm an expert in retirement account investing. So that's kind of my lane. I'm going to explain to you guys how to participate in this type of investment strategy with retirement accounts, as well as much more. At this point, my screen should be shared for my actual presentation. Can someone confirm that they're seeing that? Checking the chat.
Yeah, you're all good. We
Okay,
can see.
perfect. Okay. So again, Corey DeHarsh, I've been with Advanta IRA for about 9 years. The company's been around for 21 years. We've got about 13,000 active clients, just over 3.3 billion in assets under administration. So we've been doing this for a long time, and a lot of us are experts. I have what's called a CISP, or Certified IRA Service Professional designation. The QR code here pulls up a bunch of my educational content, kind of like today's webinar, but we cover a lot of different topics as well. The company, again, is a self-directed IRA administrator. So compliancy-wise, we're not allowed to share tax advice, legal advice, or financial advice. It's a kind of a disclaimer to do your own due diligence before you make an investment. But if you do want to self-direct, it's very simple. We pair each client with a client account manager that answers all your questions and makes sure you have a very smooth, streamlined, simple way to invest in alternative assets with a retirement account. And any money you don't have actively invested is stored in a trust bank account with an FDIC insured institution. So your money's safe up until the point you actually choose where to invest it. At that point, you're taking your own discretion and your own kind of liability into what assets you place it into, whether that's a cold storage wallet or investing on through a crypto brokerage platform, things like that. We'll get into that a little bit more down the line on the presentation. Disclaimer that I just kind of provided. So what is a self-directed IRA? As Laura mentioned, not a lot of people even know that these exist. It's basically an IRA with an administrator like us that's not a fiduciary or a financial advisor, that simply follows the IRS's rules and lets you invest into any asset class you would want to. The IRS has very limited rules, which I'll get into as well, as to what you can and cannot invest into. It's actually easier to tell you what you can't invest into than what you can, because it's so broad as to what you can use your self-directed IRA for. And not a lot of people even know that these exist. There's only about 4% of US-based retirement accounts that are currently being self-directed. And in the grand scheme of things, that industry, IRAs, 401ks, other employer-sponsored type plans, have about $40 trillion in them in the US. So only 4% of that 40 trillion is actively being self-directed, not because it's too risky or too scary. The client has to take their own risk and make their own decisions. It's because people just don't know these exist. They've been around for longer than I have, to be honest. But people just don't know they exist because they're usually with a fiduciary or a financial advisor that says, oh, that's too risky, that's too scary, because they want to keep your money in their hands where they're earning interest or points or investing your dollars on their behalf as well as their own. So everyone has the ability to self-direct. It's just not a lot of people know it exists. Once they find out it exists, a lot of them do switch over. If they're not moving their whole portfolio, they're at least diversifying into self-directed assets like cryptocurrency, things that your fiduciary will not let you hold because they do their own underwriting and choose and pick for you what investments they allow you to invest into. Even if they call themselves self-directed, if you can't go to them and say, hey, I want to buy XYZ, and then let you do it, they say, oh, no, you can't for this reason or that reason. It's not a truly self-directed account. So again, why do people switch over to self-direction? It's a new source of capital for investment strategies they're already participating in. They're getting fatigued with the stock market. You know, the fluctuations over the past few years have driven a lot of people away from that sector of the investing world. And then the tax benefits as well. As far as investing through a retirement account, you're either using a tax deferred account or a post-tax or Roth account. So all the interest and profits you make within these accounts, you don't pay taxes on them either until you distribute that money out of your retirement account later in life, when you actually officially, quote, retire and start using that money for your personal expenses. Or if it's a Roth account, that means the money in that account was already taxed on the way into that account type, and you never pay taxes on it in the future. So those are the key reasons we see people moving over to self-direction. It may be a platform of multiple of those that are your reasons, but they're basically a lot of different reasons and ways that people switch over and find benefit in having a self-direct account. Now, as I mentioned earlier, there's a number of different strategies, crypto being an emerging market that we're seeing a lot of people jump into right now, but also real estate is one of our higher asset classes for client base. You could do unique things like fund as a producer a movie project, or invest into a sports team ownership, or burial crypts, a lot of different things. Again, as I said earlier, it's easier to tell you what you can't invest into than what you can invest into. Contribution-wise, most people fund these accounts either by transferring existing IRAs or rolling over employer-sponsored plans. But you can also, if you're just getting started and don't have a retirement account, just make a new annual contribution. The limits are based on the plan type. The plan type that you set up is based on a conversation with me as to what plan fits your needs best. If you're a small business owner or self-employed, there's employer-sponsored plans that probably work better for you because they have a higher annual contribution limit. If you've got a W-2 job and are not really participating in an employer-sponsored plan, or even above and beyond that want to set up an IRA, everyone that has income that they pay taxes on is eligible to set up an IRA, whether it's traditional or Roth, and make a new annual contribution into it. I'm not going to read this chart here on all of the contribution limits, but I just wanted to provide it for reference. We also offer education savings accounts and health savings accounts. If you're someone with a high deductible health policy or have a small one in your life that you want to set aside tax sheltered money for their educational expenses and invest it into these types of asset classes, you can do so. And it's a really, really tax advantaged account type for those situations. So the only way that the IRS restricts these self-directed accounts are by labeling certain individuals close to you as disqualified persons. You're not allowed to do transactions with disqualified persons. And there are certain taxes that apply to some investment strategies, not really in the crypto space per se, but that's the only real regulation that they have on these account types. So let's dive a little bit deeper into disqualified persons. That basically means anyone on your lineal family tree, your parents, your children, your grandparents, your grandchildren, as well as any businesses that those individuals own or control day-to-day operations of. You're not allowed to do a deal with those entities or individuals where you're buying, selling, lending to those disqualified persons. That's basically it. It can be a brother, distant family member outside of your lineal descendant tree or ascendant tree. It could be a friend. It could be just a business associate. You can transact with any of those individuals outside of this disqualified persons list. Now, funding the accounts outside of contribution, which I already went over, the other ways to do so, which are more common, are transferring from existing retirement accounts that you have an IRA, you want to move funds to a self-directed IRA, you have a previous employer or potentially a current employer 401k, 403b, thrift savings plan, and you want to roll over funds out of those accounts. Those are more common. They do not create taxable events for you unless you choose to do a Roth conversion and pay the taxes at that point so that the funds can grow completely tax-free moving forward. In certain cases, there's some tax reporting. I'm going to get into that within the next few slides, but you're not taking a tax hit to move money out of one plan into a self-directed plan. With a custodian to custodian transfer, it just is very simple. You fill out a transfer form for the company you want to receive the funds. They send that over to the company currently holding your funds, and that's usually facilitated via wire within 5 to 7 business days or so. With a rollover, you have to initiate a distribution request out of that plan. So that does create tax reporting, but I'm sorry, let me flip the slide here. That does create tax reporting, but as long as you roll over the funds into a new qualifying plan, that is also reported to the IRS and you have no taxable consequence for it. So it's like a seesaw. I distributed money out of plan A, I rolled it into plan B. As long as the dollar amounts match, there's no tax consequence for doing so. This is done typically via check. I've only seen in my 9 years with the company a handful of rollovers handled via wire. So it's a little bit longer lead time because a check's getting placed in the mail, deposited once it reaches our office, and there's a 7 calendar day deposit hold on any check we receive. So if you're funding via rollover, expect closer to 2 weeks or so before you're able to actually turn around and invest those funds into whatever asset it may be. And I'm going to talk about the different strategies specifically for cryptocurrency investing through a retirement account based on what we've seen and what our clients actually like to do to make simplicity in that capacity. There's also an indirect rollover where you can actually make the funds out of that distribution payable to yourself. And then you have what's called 60 days from constructive receipt, the day that check hits your mailbox or that wire potentially hits your bank account, to push that money into another qualifying plan and allow you to keep the tax shelter benefit of that money and get it reinvested through a retirement account. You're only allowed to do an indirect rollover once every rolling calendar year. So if you did one today, you can't do that again until March 21st, 2026. So that's a lesser utilized tactic and strategy, but for someone that might need to use a personal loan or use that money for some personal capacity, you do have that flexibility and ability to do so within roughly 2 months of a time frame. Now, I mentioned earlier, previous employer-sponsored plans, as long as you have a job that you've left and an employer-sponsored plan there, you're 100% always able to move funds over into this type of account. But also, if you have a current employer-sponsored plan, you can check with your plan provider or your HR department, benefits department of your employer, and ask if you're eligible for what's called an in-service rollover. It's always negotiated in the plan agreement between your employer and your retirement account provider if they allow for an in-service rollover. So that means you can break off a leg of your retirement plan through your current employer and move it into a self-direct account to start doing this type of investment strategy. There's no black and white rule. It always depends on that plan agreement between the employer and the provider they're using. So investing into Bitcoin, that's what we're all here to talk about. There are two key ways to invest into Bitcoin and other cryptocurrency related assets through a self-directed account. The first way is a direct brokerage or trading account. So you set up a self-direct account, you provide us the contact information for the brokerage you want to work with, whoever it may be, OX or StoneX, any of those groups out there. As long as they'll allow you to set up a trading account directly in the name of your self-direct account, we'll facilitate that. We'll send the funds over, and then you'll trade as you will with that capacity and that setup. That's option one. Honestly, that is the lesser utilized option at this point, mainly because a lot of those platforms are just not currently set up or not facilitating direct investments. So what a vast majority of our clients have been doing since this space really started to emerge is setting up what's called checkbook LLCs with their retirement account. And through the checkbook LLC, you basically use your retirement account and establish an LLC that's fully owned by your retirement account, set up a bank account in the name of that LLC. We process a transaction, send the funds into that bank account, and then you can go out in the name of that LLC, hold your own cold storage wallet, invest into a brokerage through the name of the LLC, and do whatever you want in the space. Again, as long as it's following the rules I outlined earlier with disqualified persons and prohibited transactions, you're allowed to do anything under the sun. This strategy, the checkbook LLC, helps you consolidate down the fees due to the asset administrator. Whether you go with Advanta IRA or another company, they're going to have fees based on your total assets or the total value of your account. If you're doing an investment through an LLC and you're on a flat rate per asset status, just having that LLC is the only asset that the administrator sees on their records. So you can hold 20 different cryptocurrencies or 7 different brokerages, and you're still only being billed for one asset, being the LLC itself in that account. So that's another great utilization of this strategy. It also helps you diversify. Maybe you want to hold cryptocurrency and you also want to go do a private loan to somebody or invest into physical real estate, owning a rental property or something like that. As long as that's all encompassed within that LLC vehicle, you're really consolidating and helping cut down on any fees due to the administrator of that account. Now, with LLCs, again, you can hold the crypto in a cold storage wallet. You can hold a digital key or have a brokerage account. The options are really limitless in that capacity for you. With the LLC, some of the simple rules to outline for you. The LLC is going to be a manager-managed LLC, appointing yourself and any other appointees you choose as managers of the LLC. It cannot be member-managed because the LLC is owned by the retirement account, which is the member, and a retirement account is not an actual human being capable of making physical decisions on behalf of that entity. So that is the reason in the operating agreement you'll draft up. It could be a very simple LegalZoom 1 to 3 page operating agreement. You could go to an attorney and have more in-depth operating agreement drafted up, but it does need to be a manager-managed LLC. Your IRA is going to be the complete member at 100% ownership, and whatever dollar amount you push into that is up to you. It can be all of your portfolio. It can be a portion of it. You can always add more funds later because you're the only member, or more directly, your retirement account's the only member. But that is kind of the capacity of these LLCs. You can also do a multi-member LLC if you wanted to consolidate maybe yourself and your spouse or yourself and another investor's money, but that then becomes a multi-member LLC, which does have some taxable reporting that needs to be done. So in a lot of cases, it's simpler and cleaner just to do a single member LLC and then maybe set up a tertiary LLC after that you and other investors invest your single member LLCs into. That's more technical. That gets down the line of something your client account manager would explain and strategize with you for. Now, some of you may be thinking, okay, a retirement account owning an LLC, is this completely legal? What about me being the manager of it? That's all been supported in legal situations in the past. I cite here Swanson versus Commissioner and the tax court memo of T.L. Ellis. Those are basically cases that went before the courts. And in the case of Mr. Swanson, he was serving as his own LLC's manager, and that got brought up through the IRS. It was determined that he is allowed to be the manager of his own IRA-owned LLC, but he cannot compensate himself for doing so. So in this case, this is all in the interest of generating passive income for your retirement self, your post-working life. So you should not be compensating yourself for any duties, activities, trading that you're doing within your IRA's LLC or within your crypto space, however it may be. The other side, the tax court memo for T.L. Ellis, that gentleman actually did pay himself, and it was then further ruled that you cannot do so. So those are just some case studies to support that this strategy is allowed and available to you by way of checkbook control. So you can set up an LLC, which is mainly what I'm talking about here. A very similar strategy to an LLC is setting up a trust within your retirement account. And the main difference here, they basically function in the same capacity, but with a trust, you're not allowed to serve as the trustee of your own retirement accounts held trust. So you do have to appoint a third-party trustee, whether that's a family member, a friend, or an actual trustee service that you go out and find. You cannot be the actual trustee. So if you set up a trust instead, that brokerage or trading platform or cold storage wallet is technically going to be held by your trustee, not yourself personally. So in a lot of the capacity of the strategies we're talking about today, the LLC is probably going to be a better fit for you than the trust. But I just wanted to express that they're both options that essentially accomplish the same goal of your ability to invest into this space. It's a very simple process to set up these LLCs. Basically, you can do so yourself, or if you're not so comfortable with some of these aspects, you can have a attorney or a CPA set this up for you. They typically charge roughly around $300 to $500 for their services. But all you need to do is go to the IRS's website and get a tax ID number in the name of the LLC you're establishing. Obviously, after you'll establish the LLC in the state of your choice, it does not have to be your primary state of residence. For various purposes, again, I can't speak from a legal capacity, but for various purposes, people set up their LLCs in Wyoming and Delaware and Texas. There's different reasons for tax benefits or other benefits, anonymity and so forth, that you may want to set up the LLC outside of your actual primary state of residence. That's perfectly fine and allowed. Once you have the tax ID number and your articles of organization, you provide us an operating agreement. Again, it's very simple. We just have a few bullet points that we outline to our clients as to what needs to be in that operating agreement. Above and beyond the mandatory minimum things, you can add your own discretionary items there as well. Once we have all that information, you go to the bank of your choice and say, hey, I've got this tax ID number. I've got this document showing I'm the manager of this LLC. I just want a basic business checking account. Once you set that up, we execute a transaction, fund your money into the LLC, and then you go on so forth and invest however you'd like to with that entity. A few helpful hints for establishing these LLCs. You're typically going to want to name it really whatever you want, but we ask you both for the banking side of things and for the regulatory side of things, not to use the term IRA or 401k for that matter in the name of the LLC. So it could just be John Doe Invests or John's Crypto LLC, something like that. Anything you really want it to be. We've seen some really unique ones. We've seen some really plain Jane ones. It's completely your discretion, so have fun with that. The registered agent typically is just going to be yourself, and you can list your primary address as the registered agent address. You could use a third-party registered agent like your attorney or something like that if you want to, but it's not necessary. And then again, the management of this LLC is usually up to you or any other appointees. Sometimes people will appoint their friends or spouses or other family members as registered agents and or managers of the LLC. So there's some basic reporting, just renewing the LLC on an annual basis, providing an update to the operating agreement or quote minutes of the LLC, even though there's not too much activity there, just making sure you're keeping up with it. So you're in the good standing of whatever state you incorporate in and the IRS as well. And then basically invest. It's pretty simple to that aspect. Again, the operating agreement is very straightforward and standard. You can just go on LegalZoom or I Googled when I set up my LLC, single member LLC operating agreement. I found a 3-page template. I looked through it real quickly, made sure I made the amendments I needed to, and then got it all set up, ready to go pretty quickly and easily. I pretty much went over the provisions already here. Again, you can have a multi-member LLC or you can have a single member LLC. It's probably preferred with this type of strategy to just do a single member LLC. You can always set up provisions as to how and when you're going to terminate the agreement. With the single member LLC, it's not necessary per se to have resolutions as far as if there's disagreements between the members, because the member's your retirement account and you're the manager. So I don't know how many disagreements you'd be having between each other. But those types of things are additional considerations you can choose to have in that entity. Again, obtaining a tax ID number is very easy. There's about 6 pages on the IRS's website. If you're someone looking to do this, I've got screenshots taking you all the way up through the signature page and execution page that I can send you. It's basically the equivalent of this SS4 form I've got displayed here. Very straightforward and simple. It took me 10 minutes to set up my LLC 2 years ago. So, or at least obtain the tax ID number for it, rather. A few other helpful hints when you're going to the bank of your choice. It's very easy for a banking center associate, and I speak with experience. I put myself through college working in banks, credit unions, major banks. They don't know about the retirement investing world. They don't know about self-directed IRAs. So if you go in and you get too convoluted saying, hey, I need to set up this LLC for my IRA, this, that, or the other, they're going to get confused. They're going to think they need to sell you on their IRA product, and you're going to get brought into the bank center manager's office and get on the phone likely with someone from their higher corporate compliance team. As I stated earlier, all you need to do is say, here's my tax ID number, here's my operating agreement proving I'm the manager and authorized signer on behalf of this LLC. I need a bank account, a standard checking account. You can have a saving account as well. What you cannot have is a line of credit. So you cannot open up a personal line of credit because, again, the member of this LLC is your retirement account. Your retirement account is separate from you. It's a separate entity and not a human being or an individual. So it cannot have a line of credit open to it. Otherwise than that, we have a few financial institutions that are very familiar with these strategies we could refer you to. It's pretty easy, though. You can go to the bank you're already using and set up this type of account. It's really easy. Again, I'm just going to outline here in a few slides how easy it is to set up these accounts. You complete an application with your retirement account administrator. With us, we send an application via DocuSign. It's typically 6 pages, takes about 10 to 15 minutes to complete. When that's done, the IRS has what's called a 7-day right of rescission period before you're allowed to fund any investments. So in those 7 days, we're typically getting the account funded from your previous IRA, 401k, new annual contribution. We're getting your operating agreement, your tax ID number, so we can have you set up the LLC bank account and be ready to fund that. So on that 7th day or as soon thereafter, as we've gotten all your LLC paperwork and we've received the funds from your previous source or new contribution, we can execute that, send the funds out, and let you proceed with your investments however they may go. It's also important to note, again, I believe I said it, you can always add money into this LLC later, or if you wanted to liquidate any portion, you can do so. At this point in time, with cryptocurrency specifically, you cannot take a personal distribution of it. So you could distribute ownership of the LLC in kind out of your retirement account to yourself personally, but you can't just move the money out of, move the cryptocurrency out of your LLC and take that in kind. So you'd have to be taking a portion of the LLC itself in kind if you wanted to do so as a personal distribution, so you could start using it personally. Otherwise, selling that off, reconverting it to actual physical US dollars, and then taking those US dollars is currently the way that's being handled. Obviously, it's a very quickly emerging market, so maybe the IRS within the next year or so, few years, may have some updated regulation as to how they want to handle that. But as of right now, that's the strategy or way around that situation. So once the LLC is set up, we go ahead and fund it. You can invest however you want to, whether it's setting up an account with StoneX or with OX or any of those other groups out there that you might be familiar with, setting up a cold storage wallet and doing that yourself personally in the name of the LLC. As I said multiple times, the options are endless. It expands past the cryptocurrency space into any other unique asset class you might want to invest into, as long as it's not dealing with disqualified persons. The only assets that you can't invest into, I believe I missed mentioning this earlier, are hard to value collectibles like antiques, fine wine, artwork, basically anything subjective in value. I like to use the example, I have a neighbor up the street that had an old rusty 70s Corvette in his driveway. that's something he might say, oh, with a little bit of elbow grease, this is going to be worth $70,000. I think it's worth the scrap metal that it weighs sitting in his driveway. So that's subjective. He has a higher value based on his own preference and expertise. The IRS doesn't want those types of assets in the account, but anything outside of that can be held in a retirement account. Obviously, cryptocurrency is a very unique asset class at this point, so it may be valued differently and things like that, but it is still allowed within your retirement account. And like I said, it's a very emerging market. I think 2016, 2017, we started to see some investments, and then 18, 19, 20, we really saw a boom that's still continuing now for people investing into this space with their retirement account. Funding the account and operating the LLC. We push the money into the LLC. You invest with it there. If you ever want to take personal possession and use of the funds, you do have to execute a distribution that's reported to the IRS. So the funds, as I just described a slide or two ago, have to flow back out of the LLC to your administrator and then be processed as a distribution. If it's not funds, if it's asset in kind, whether it's property, whether it's cryptocurrency, we're going to have to distribute a portion of the LLC's ownership to you that's reported to the IRS at the actual face value of whatever that asset is. And then again, that single member LLC is going to dilute its ownership interest. So it's going to become a multi-member LLC if you're not taking the whole thing. So that's something to keep in mind as well. Multi-member LLC has a little bit more tax reporting and documentation to the IRS. So speak with your account manager, whether you're going with Advanta IRA or any other custodian that you may choose or find out there. There's a lot of different companies in this space that can help you with this. Obviously, I stand behind our customer service and our knowledge and expertise, but there's enough pie to go around for all the companies out there. If you already have a self-directed account or cross-comparing other options, that's perfectly fine. As you invest, you would use the LLC to make all of the investments, whether it be through a checkbook or a debit card, or once you convert the assets to other capacities like through a cold storage wallet, that's all in the name of this LLC. Your signature as manager is justified to execute any transaction you'd want to based on that LLC's operating agreement. So which strategy is best for you? It really depends on your personal preference. As I stated earlier, most of our cryptocurrency investing clients do so by way of the checkbook control strategy, but there's no reason you can't set up a direct brokerage or trading account with one of the platforms you already know. It would just be connecting them with your client account manager so they can work out the details from that. And from there, you just pretty much create your account on the platform, provide us the account information and details, and then we execute that transaction to send the funds over to that platform so you could proceed with your investing strategies. Just a quick note, Advanta IRA, we do a lot of educational content. We typically do 2 educational webinars a week on various topics. Well, we've covered cryptocurrency, we've covered any other thing under the sun. You can check that out on YouTube or go to advantaira.com. We have a podcast called the Alternative Investing Advantage Podcast. That's more of a free-form, relaxed conversation with my colleague Alex Burney and investing experts through all different industries that just talk about investment strategies and things like that. And we have blogs about the self-directed investing space as well. So you could check those out if you're interested any further. Getting an account set up, as I mentioned earlier, is very quick and simple. It's about a 15-minute application. We get the account set up, funded, and ready for you to invest in about 15 days, roughly. Depending on how you're funding it, could be as short as 7 days. I try to say 10 to 14, 15 for a conservative estimate, just so you're not cutting a tight timeline with anything you're trying to do. And then invest as you see fit. Contact us if you have questions about the IRS rules or regulations or anything specific you want to do with the account. At this point, I'm happy to go over questions, or we could hold them till the end. I know we're going to have a larger Q&A session with the rest of the panelists later. So Laura, I'll turn it back over to you, and happy to handle anything I need.
Yeah, thank you so much. That was awesome. Can you hear me?
Yes.
Yeah, very good. So again, we'll go over the Q&A. This was such an important topic, which I feel like it ties in very, very well with the tax conversation, because, any retirement chat would probably have a lot of tax questions and implications. And thank you so much, Corey. Again, you have Corey's details on the screen. We'll go and have more Q&A at the end. Corey, if you want to stay tuned for that, that would be great. And now I will take this over and tie it all together into how does it all, come to be on the tax world? What's the tax efficiency of all of it? So how do you protect your money that you earn, that you invest, that you mine, and all of the in-betweens on the tax side? So let me see if I can share my screen. Let's see, and let me know let's see if you can see my screen. Um, I hope you guys can see my screen. All good. Cynthia, can we see that? Yes, very good. Well, let's kind of tie it all in. And I want to go over a couple different things. And I think each one of our speakers was, talking about at least one of these sections. And we're going to tie it in and really bring how does it all come to be reported on your tax return, what kind of the strategy that you would use on either one of them. So the topics will go, kind of like the holding. I think James talked a little about, the huddle, right? Aspect of cryptocurrency and especially Bitcoin. We're going to talk about the harvest losses to offset gains. The next topic will be donations of appreciated crypto. Very specifically, we're going to cover Bitcoin. So when you see crypto, don't get sidetracked. We're talking about crypto today. That is to avoid capital gains and claim deductions. How you can gift Bitcoin or other currencies to really shift wealth tax-free. And the last one is going to be using tax-advantaged accounts to align your Bitcoin investing with the business income cycles. Again, this is all made with the business owner in mind. So, please, put your questions in the chat. At the end, we're going to go and answer the questions and see how does it all come to life if you have a business that already is operating, right? So the first move is how do we hold long term this Bitcoin that you are either mining or you're just buying it to hold, right? Why would you want to keep Bitcoin or any type of investment? Because you have that capital gain if you hold it for 12 months or more before you're selling it. You get the capital gains rate, which in 2025 are 0%, 15%, and 20%, depending on your income tax bracket, right? So after 12 months, your profit or your gain really qualifies for that long-term capital gains. And if you do not hold any type of Bitcoin more than 12 months, you will be taxed as your regular tax rate, right? So when we hold it long term, what it does is reduces my taxes owed, on a sale. And if I hold it, it really defers the tax, so I don't have to pay anything until I cash out. So the example is if I buy Bitcoin for $30,000 and I hold it for a year and a day, 13 months, whatever you want to call it, and I sell it at $45,000, if I hold it, right, there's not going to be a tax on the gain only when I sell it. When I sell it, I pay $15,000 capital gains on the gain only. So I know all of you know the math. I'm not gonna bore you with that. If we're holding it less than 12 months, this is the kicker where it's going to be taxed as ordinary income tax rates. And if you already have a business, it could be a partnership, it could be an S corporation. If you're, getting money coming in from various sources of income, you have different investments that you might be at a higher tax bracket. You could be at 37%, and your gains would qualify at the highest tax bracket, including your state taxes, right? So that's why I don't want to sit on this too long. I know you understand the long-term aspect of this. This is probably the easiest one to get. Plan your exit really timely when you want to exit, any type of cryptocurrency and Bitcoin. And a lot of the people, I think, left the industry when it went down a little bit. Let's say you buy it at $100,000, and now you went to, your investment is valued at 175, and it starts dropping. A lot of people were starting selling their Bitcoin just because it started dropping. And as you can see, that graph was going up. And I think Eric showed us the graphs and James showed us the graphs. If you sell, if you have a profit, you still pay the capital gains, even if it dropped. I hope that makes sense. So I'm going to go to the next move, which is probably a little bit easier to absorb and easier to take advantage of, because we can harvest losses from Bitcoin if you have a large drop. And I'll tell you the number one advantage of, selling your Bitcoin if it's at a loss is because we don't have the wash sale rules yet. And what does that mean? For example, if you buy stock, the wash sale rules apply. You can't buy or you can sell a piece of stock and buy it back the next day or the same day because you have the wash sale rules, which it's not true yet for Bitcoin and cryptocurrency. So when you sell crypto, you can sell it today at a loss, take advantage of the loss, go back to the market, buy it back again, and then you still have the same holding if the price is the same. So what does that mean? That means if I have 100,000, like I have an example here. So let's say I have crypto at $15,000 profit, like we just mentioned. And, I have, a loss of $1,000 on it. If I sell it today, I'm going to take advantage of that loss on my tax return today of $8,000. And to maintain my position in the market and to maintain my investment in Bitcoin, I can go back the next day and buy it back for the same money if it didn't fluctuate. So this is an amazing, very, very simple, strategy that you can use. Now, keep in mind, does it make sense to do it just to do it? Not necessarily. On the capital gains rate, we have up to $3,000 you can deduct every year as capital loss against ordinary income. However, let's say I sold a piece of property. It could be a piece of real estate. It could be I sold shares in a business. It could be that I sold any other stock on the market and now I have a larger capital gain on it. I can offset that gain by the capital loss that it can produce from the harvesting of the losses on Bitcoin or cryptocurrency. So I hope you can see how this makes very much sense. When I already have capital gains on my return, this is something that you would want to do before the year end. And how would this take place? So for example, right now we're in 2025, and in tax planning, you're looking ahead. Did I sell a piece of property? Yes or no? Maybe yes. Am I having a capital gain for the year? Do I estimate to have capital gains for the year? Let's say I have 100,000 in capital gains for the year. Now, if I know I am going to have that, the minute I see a dip and I can really take advantage of a loss on my Bitcoin, I would go and take advantage and just sell it and buy it back up, because that loss, I can take advantage. It doesn't matter when it happened during the year. I can take advantage on the 2025 tax return. Okay, so just keep in mind, I know it's very simple, but you can only take advantage of the gains and the losses in the same calendar year. So whatever happens in this 2025 year, you can use losses or harvest losses for 2025. Now, if I have excess losses, let's say, and I'll give you, this is a topic it's very simple, but we can talk about this for so many different scenarios. Let's say if it was a big drop, let's say in December, which was not a big drop in December, but let's say December was a very big drop, but you had no gains in December. But the next year I'm going to sell a property. I'm going to have capital gains either next year or the next year. And I know my losses would carry forward. Now, when you have any type of position in Bitcoin or any cryptocurrency that you can harvest the losses, I would do it when I have the opportunity to do it. Because let's say I can generate from a big loss in 2023 or 2024. And even though I don't have any capital gains in 2024, I'm going to create this carry forward. I'm not going to take advantage of that here, but I'm looking forward. I know I will have capital gains. So in that case, when I see a dip, take advantage. There's no wash sale rules yet. So I anticipate that this will change sometimes in the future. I hope it's not during this administration. It doesn't look like it could be, but it's very possible. So if that changes, you might have a limitation. So if that puts you out, that you cannot buy the same Bitcoin, the same type of currency back for 90 days, that will limit this ability to harvest these losses. This is the easiest way you can do it right now. So if you're holding anything that is, it's especially in the crypto digital currency market, this does not apply to stocks and bonds. This applies for cryptocurrency, digital currencies. Harvest those losses. So I hope you can, go and take a look, watch your cost basis, and we'll talk about the basis, because many people do not know what's their loss at any point in time. which, kind of brings the question, how do I know what's my loss? Because you might have purchased multiple layers of digital currency throughout the years. Now, unless you track, you would not know if you're at a high gain or at a loss. So I really encourage you to track it. We'll talk about tracking a little bit, but harvesting losses is really, really easy, and we should all take advantage of this. This is probably the easiest one to use. Okay. Next, smart move number 3, donate appreciated crypto and Bitcoin. This is, I love charitable deductions, and it's not necessarily for the idea that you're giving out of the goodness of your heart. You can give out of the goodness of your heart, which that should be something that you do regardless of a deduction or not a deduction. Okay. So when I speak about charitable or any type of donations, I'm speaking about a tax strategy. A tax strategy is when I'm very specifically giving something for the purpose of a tax write-off. Okay. It could align with your, beliefs. It could align with what you want to do, what you want to give back to the world, to the communities that you want to support. But it doesn't have to be, they could be two separate things. And I think when we combine them, a lot of people have a lot of conflicts in their belief systems. Like, well, it kind of defeats the purpose. Keep them separated. This is a strategy. So when I talk about charitable and donations, I'm talking about a pure tax strategy. If you want to line it good, if you want to give out of the goodness of your heart, just do it without seeking a tax write-off if that's what you believe. So we got that out of the way, which I know a lot of people ask me over the years. So what does it mean to donate appreciated cryptocurrency or any digital currency? You can donate it to any nonprofit. Now, you have to understand the donations, and I know it's a very simple concept, but I want you to understand that donations, to be able to be deductible on your tax returns, you have to donate to a U.S. entity, nonprofit. So the IRS grants nonprofit status to various organizations and foundations. And when they give them the nonprofit status, they have to have a disclaimer. They have to say anything you donate here is tax deductible on your tax return. If it doesn't have the blurb, it should not be a nonprofit. Okay. So, we're not talking about political organizations, lobbying and all of that. No, nonprofits. And it has to be U.S. entity to be able to write it off on your tax return. So what can you do? You can donate, and I'll back up for just a moment because I want you to understand the principle and the tax law behind it that allows you to do it. Whenever you have an asset, it could be anything. It could be a piece of property. It could be stocks. It could be any type of investment in digital currency. It could be art. Anything that you have, when you have assets that their value appreciated in time, the IRS and the code, they would allow you to write off, the value at the time of donation. What does that mean? And we have a lot of strategies that go just around this concept alone. So when you think about it, if I buy, let's say, for example, I have a piece of stock that I inherited from my grandmother. And, let's say it appreciated, I don't know how many times. Like, let's say they had Microsoft, right? And it has high appreciation. Now, for me, it might not be beneficial to sell the stock and get the money. It might be more beneficial. And when I do the math, the tax write-off for me to donate that stock, we would be much greater than just taking or getting the capital gain because the tax will just hit me. So all of it is driven by the calculation. What does that mean? That means that you need to know when you make these contributions, these donations to nonprofits, how will that work for you? And when you think about that, you have to kind of put it in perspective. If I give $100,000, I literally write off $100,000 if my income is high enough, right? If I sell it and I have 50,000 capital gain on it, right? Will that make more sense depending on your tax bracket? So it's all about timing and all about knowing the calculations. So, I have an example here. Let's say you buy Bitcoin at $10,000 and now it's worth $25,000. When I donate it to a nonprofit, I can say, I really, I support there's various organizations that I support, and child trafficking is one of them that I just, I like to support, and I would like to donate to them. So I can say, hey, I'm donating this $25,000 worth of Bitcoin. Now they can take it, do whatever they want with it. They can hold it, they can sell it. If a nonprofit sells it, they don't have any tax because they're not taxable. But I get to deduct $25,000, right? Versus I have to pay capital gains on $15,000, which I could be on a 20% tax bracket. So I hope you see that it's all about timing and it's all about deciding, knowing the math. And I hope you have an account that you can have this conversation with. Say, hey, you know what? I'm contemplating, I have this appreciated asset. Now, could it be Bitcoin? Could it be something else? Absolutely. Can I donate it? Will it make sense for me to donate it? Or do I just take the capital gains on it? Okay, if you have losses. Now, a lot of people ask, can I donate it to my own nonprofit organization? You absolutely can. A lot of our clients have their own foundations, their own nonprofits that they support. Can you do that? Absolutely. Okay, so if you have that, and if you have a nonprofit, just make sure that you have a legit nonprofit, right? That is has the nonprofit status that is set, and you receive that from the IRS. Okay, so I want to just bring in the conversation of a donor advised fund. What's a donor advised fund? There are these funds where they're very, very common. The Charles Schwab has it, like many other companies have. Fidelity has DAF accounts. What you can do is you just bulk multiple donations into one. Let's say instead of taking 20,000 every year as a deduction for my contributions, I can just pile up. I'll do one big lump sum. I can give $100,000 in a year that I would need the deduction more than in other years. And into a DAF account, you can include, or donor advised fund, you can include cash, you can include Bitcoin, you can include collectibles, art, you can include so many other things that people do not know about it. It's so easy to set up. I really recommend all of you to have one account open. Just put something in it that you have it. Open it so you have it and you can contribute anytime before the end of the year. So the contributions, the deadline to make any type of contribution is really 12/31. This cannot be done later on. This is not a retirement contribution. This is not up to the extension of the tax return. It has to be done by 12/31. And if you have for example, Bitcoin and any type of digital currency that you are going to donate. Again, the same conversation about what was your cost basis, right? What's the value when you donated? Make sure that that is being tracked and that because when tax filing time comes, it will be very difficult to come up with the numbers. What did you donate? How did you donate? How did you evaluate it, right? How did you know how much that was? The value. I hope that makes sense. Again, donation of appreciated digital currency is really a great move. Now, the other one would be gifting. And a lot of you say, well, I don't want to gift my my digital currency. But there are some things that are really small that compound a lot over the years. And the smart move number 4, as a tax strategy, I want to invite you to think about gifting Bitcoin to your kids, to your spouse, sometimes even to your grandkids. Again, we're going into some gift law here, but I want to keep it very, very simple. So when you give, you can literally give up to $19,000 in 2025. Okay, so let's say my husband and I, we have 3 kids. I want to donate or gift, really, $19,000 worth of Bitcoin to each one of my kids. Why would I want to do that? I would do that to just take it out of my estate. If my estate value is really high and I don't want to think about, hey, I might have estate taxes, just taking it out every year, moving in and if it's a long-term hold, I don't plan to take the money out. I would rather be in their names than to be in my name. They're not going to have capital gains if we're just holding it. So we're not worried about kitty tax. So that if your strategy from everything you've heard is not mining, is not retirement, is really buy and hold long term, gifting to your kids and your spouse, if you have it in your name, if you have it in your wallet, I would go and say, hey, I'm going to gift 19,000 every year to my kids. Can you gift it? Now, each kid can get two, one from the mother and one from the father. So you can have $38,000 that can be gifted per child every year that gets out of your own estate. So I hope you can see the value. Now, there's a lot of misconception about gifts and the annual exclusion amount. Now, the gifts exclusion amount kind of follow the estate cap for an individual. So right now is at what, 13.6 million. And it doesn't mean that if you gift more than $19,000, you will be taxed. It just means that you have to report it. So any gift that you make that's over $19,000, it has to be reported. Why? Because it reduces that cap that you can give in your lifetime. So your lifetime exclusion is the same. Okay. And if you reach that cap, then it gets to be reconciled on your estate tax return when you die. I hope that makes sense. I know when we go into the gift tax rules, it gets a little bit more, convoluted and kind of complicated to kind of wrap our head around because we have a lot of, GST tax and all of the other ones. So I want to keep it very, very simple. If you keep it below 19, or you can give 19 per individual, so each person can give to another individual $19,000. There's no reporting. There's nothing you need to file with the IRS. If you give more than $19,000 to one individual, one social security number, you as a giver, right, the one who gives the money, will have to file that Form 709, which is a gift tax return. Okay, so that's really what, all that I would probably kind of tackle on the gifting. And I hope you can take advantage of this. This is so easy. It compounds over time. Imagine if you have 10 years and in 10 years you have gifted, it was 18 last year, 17. Let's say you gifted in 10 years $150,000. That compound effect for one child, for the buy and hold, anything, it could be anything that you gifted, right? That's amazing. A child can go and buy a house when they're aged to buy a house, whatever the case might be, if that's something that interests you. So I hope you see the amazing benefits of gifting. Now, this is probably my favorite one because it kind of ties it in with what Corey was talking, and using tax advantaged accounts. Okay, using the SDIRA. So by now we all know what an SDIRA is. That is a self-directed IRA account or a solo 401k. I saw some questions about solo 401ks to invest in Bitcoin without triggering any capital gain taxes inside the account. Why would this matter? Because when you are in a retirement account, you defer. It's a deferral tax strategy, right? Eliminating taxes only works if you do Roth. And we'll talk about this. I want to sit on this for a little while because I want to make sure that you see the benefit on either side of the spectrum. There's no one side better than the other. It's how can I use them for my own benefit to really get to my goal as an individual, as a family. If I'm building a legacy, if I'm building wealth, if I'm building generational wealth, how do I do it in the most tax efficient way? So really that's the question and that's the goal. So let's go a little bit and talk about the retirement accounts because there's so much talk about retirement accounts. And some, you hear people saying 401ks are evil. This is the worst thing you could do with your money. And depending on the crowds you're hanging out with, listen, I've been around the real estate crowd for a long time. In the real estate world, 401ks were the worst thing. People were like, no, instead of putting my money in a 401k, I'll buy another piece of real estate. This doesn't grow. This doesn't grow. So there's a lot of misconception about what a 401k is. Now, the real estate industry has shifted a little bit. The more they understand that it's just a tool, it's not, an end. The end goal is not to have 401ks. It's just a tool to get to your end goal. Now, a lot of people are opening up their minds like, okay, well, how do I do this? How do I make this happen? So when you understand that if you're in business, and this is where it all comes to be, and like, how do I fund retirement accounts that I can make investments, not only traditional investments, that I can make alternative investments, right? So the two types of accounts are traditional accounts and Roth accounts. And I want you to have this distinction. I know it's kind of, sometimes it becomes very confusing in our minds as business owners to really think of, differentiating one from the other. So a traditional account, right? It's tax deferred growth. In a traditional account, I am going to get a write-off on my tax return. It doesn't matter what return do you have. It could be 401ks, it could be cash balance plan, defined benefit plan, SEP IRAs, all these accounts that give you a tax deduction on your return are going to be part of your traditional accounts. The accounts that you contribute into that do not give you any type of write-off are going to be your Roth accounts. So with that, what do you want to make sure that you understand is that where do I want to fit in? Okay. Now, each one of them can be used at different points in time. And I'll give you a slide and I'll give you the difference of how do you align this with your business. Now, the second differentiation of retirement accounts is, I want to invest into traditional accounts that go and I can go invest in funds, right? SEC-backed accounts, and I can go alternative investments. And this is where you have traditional accounts that can be on the stock market and traditional accounts that would be self-directed accounts. I think that's a really clear distinction that I really would like you to have, that you can have traditional both, investing in stocks and bonds and ETFs and all of that. And you can have traditional accounts that invest in alternative investments, which are your SD, like self-directed accounts. Okay. So I hope that makes sense. Now, I'll take an example here, but I want to go in because I want to really dive a little bit deeper onto the type of accounts and when would you use one versus the other. Right? So who benefits the most out of these? Our business owner with consistent income, right? If you want to convert business profits into long-term wealth buckets, you want to take the money out, you want to, take it from your profits, from ordinary income, and really fund retirement accounts as much as possible. Right? And again, you want to align contributions with high income years for maximum deductions. So let's go over a couple of examples. So we have a few examples of the accounts we just talked about. Let's take it each one of them really quickly to go over them. I know you'll have questions on this, but solo 401k, right? What's a solo 401k? Really, really simple. If you have a company that has one shareholder, you're an S corp, you're a solopreneur, whatever the case might be, you're the only person working and you don't have other employees, a solo 401k might be the best one. Really easy to set up. Right? Again, for self-employed individuals, contributions, they reduce your taxable income. Again, this gives you that checkbook control that Corey was talking about, the LLC that you talked about. And again, contributions on this, it could go up to $69,000. Really great, again, between the employer and you as an individual. One thing I want to mention to this is that, Corey was talking about the checkbook LLC. And I want you, if any one of you remembers about 7-10 years ago, it was this huge hype about Rob's account, right? The Rob's account were LLCs and all these companies were coming out and saying, open an LLC within your 401k. Like the checkbook LLC concept that's available today with cryptocurrency and Bitcoin, any digital currency, it follows the same pattern as the Rob's account, where a lot of people had large 401ks, they wanted to open companies, and they didn't have cash. Instead of withdrawing the cash, get a penalty for withdrawing the cash early from the retirement accounts, they opened a corporate that was limited to corporations, a corporation within a 401k in which the 401k owns the corporation. Same concept. So if you've been around a while and you've heard all that conversation, now, that's been going on for a long time. About 10 years ago, it was a big hype about the Rob's account, right? Rollover as a business startup. So that's the solo 401k. Self-directed IRA, we talked about that. Here's the kicker with the IRAs. A lot of people don't understand that if I want to fund, I want to buy, cryptocurrency, I want to buy real estate, whatever you want to buy, right? You are limited in an IRA by the contributions. Right now in 2025, you can only put $8,000 if you're 50 or older. That will take a long time to build. That's why what my recommendation is to use multiple types of retirement accounts or funding the accounts so you can self-direct them so you can invest in alternative investments. Okay. Again, with the self-directed IRAs, you have both the traditional tax deferred growth and you have the Roth version. Okay. The limit is the same, $8,000. Again, this is great for long-term appreciation on your Bitcoin. HSA. I saw some questions that chatted with the HSA. Great strategy. I highly recommend it. So if you have an HSA, it has like a triple advantage. Tax deductible deductions, right? And you can, right now, if you're a family, you have, I think, 8,550 for 2025. That's great. Some custodians allow you to invest in alternative assets, including Bitcoin, indirectly via, SDIRA structure. So use your health savings accounts to do all of these for you, right? It really aligns well for your business owner. Because why? Because now I have a deduction. The company can contribute. Me as an employer, I want to contribute to my HSA. I want to contribute on behalf of my employee. I could be the employee that I'm contributing, right? So I have that triple tax advantage. Great strategy using the HSA for that. Again, small wins over a long period of time really compound. The last one I want to talk about here is going to be the most common right now that is popular, is cash balance plan. Again, these are advanced strategies. They're ideal for high income business owners looking really to defer large amounts of income. Again, a lot of you will hit me on this and say, well, but if I have high wages to be able to take this contributions. Yes, but the deduction sometimes, for the right candidate, the deduction and the tax advantage is much higher than your wage cost, on your taxes. So calculation is always, driving strategy, not driving calculation. Contributions here, it can be up to $280,000 per individual, right? The beauty of this, you can pair it with other retirement accounts. Besides the cash balance plan, you can have a profit sharing plan, you can have a 401k plan. They can all work together. Great strategies, right? And again, what do you do with the funds? You can have a self-directed structure within the plan, right? And again, check with your custodian on all of this to make sure that this happens. How do you align this with the business income cycle? And this is where all comes to life, because you have years when you have high profit. In those years, you want to make really large pre-tax contributions, cash balance plan, defined benefit plans, contribute as much as possible the years that you can, right? If you have self-directed accounts, all of that, we have a lot of strategies that go around this. But in high profit years, you want to really drill those pre-tax, that deferral, right? Not Roth. The Roth contributions, however, you want to use them in lower income years for long-term tax-free gains, right? So you just want to really, and I know a lot of the business owners, like, how would I know if this is going to be high profit or a low profit? This involves your accounting team. This involves make sure your bookkeeping is on track. Make sure you know what's the goal. Am I going to sell something this year? Am I going to, acquire a business? Am I going to get something? Am I going to get any type of additional depreciation? Do I have additional expenses? Am I investing into an expansion this year? What am I going to do? So you want to be in tune with your financials to really make the most out of this, because if you don't know what you're expecting to have, you can't gauge, should I go Roth? Should I go traditional? Right? So again, in Roth contributions, depending on the account, if it's an IRA, you're limited by the $8,000, which is not a big amount. Time contributions or rollover to align with your year-end tax planning. I cannot tell you how important it is to do at the end of the year, no matter what you plan, to see, when the rubber meets the road, what happened. So in 2025, Q4 is the number one or one strategy for you is, hey, what I plan to have or to see by the end of the year, am I seeing it in my financials? Do I have to make any type of shifts? Do I need additional contributions? Do I need to scale down? What do I need to make? So your contributions for retirement, they go hand in hand with your year-end tax planning, right? And again, shift excess cash from operations into long-term wealth, using all this tax-free and tax-deferred strategies. So I hope this is helping, and it opens up some ideas for you. What can you do to take advantage of it as soon as possible? Now, I don't want to scare you, but I want to make sure. I have seen, and people come to us as a CPA firm, we see so much of the back end, what happens when things go wrong and one thing goes, everything goes well. So I just want to give you a couple of, cautions here that, we've seen this happen for various different types of business endeavors. I'm not saying, to give you the horror stories, but just to caution you to really look ahead and just be mindful before you invest in anything that is looking suspicious or it looks too good to be true. So I want to give you a couple of case studies from the past few years that, took place, and just what's the lesson for us to learn, right? So I want to bring you FTX, and it was one of the largest global crypto exchanges, right? They filed for bankruptcy in 2022. Right. And, the lesson from this one is we do not rely solely on centralized exchanges. Again, understanding Bitcoin, understanding how it works, understanding how do I keep my investments is really important before you go and dive in and put a lot of money in it. And I know James did such a great job in the beginning, kind of detailing how the market looks like. And then Eric exposed the mining concept. You don't want to just go put all your eggs in one basket before you understand the structure. So make sure that you do understand what you're investing in and how should you protect yourself, having, align yourself with the right individuals. Right. Another one was, the BitConnect scam, right? They promise really high guaranteed returns to investors. So any fund, this is true not just for Bitcoin, it's true for real estate, it's true for any type of investments, right? We saw oil and gas, like any investment has to be, has to go through some due diligence. Right. So make sure that you do your due diligence on anything that you invest in and make sure you look at the track record. So BitConnect collapsed in 2018 as a classic Ponzi scheme. And the IRS put this like they had 17 million to compensate for losses. Did that really happen? I don't think so. Right. So the lesson is to really be cautious for high return crypto investment programs. We see so many people in jail. Always research, validate, the companies you're working with and the funds you're working with. Make sure you do that. Another one is there's a lot of phishing and fake wallets. And how do you protect yourself from it? Forbes had some really well-known crypto scams to watch for. I think they posted that at the end of 2024. But California has a crypto scam tracker. And I want you to do again, this is part of your due diligence. And I like to, as fiduciary to our business owners, I want to make sure that you do your due diligence. We do due diligence on anything that we tell you. So I want to make sure that you do the same for you before you go and give anything or you give them money or open your wallet, right? So in California, you have the FBI that you can go and see what do they have on the crypto scam tracker. Use them. And also the lesson is only use trusted, verified wallet software. Never share your private keys and bookmark those sites. Make sure you activate the authentication, multi-factor authentication. Another one here is, some investors, they open self-directed IRAs specifically to invest in Bitcoin. They don't understand the IRS rules for prohibited transactions. And Corey did such an amazing job kind of listing what those disqualified transactions, disqualified people are. Make sure that you work with a really, really good qualified company in this, as self-directed space, to make sure that you understand the rules. Because one check, and I have so many stories for you. I had an audit that I represented, and I've done more than 3,000 face-to-face audit defense cases. I had one case with this couple, and this was an investment in real estate. They just had one check, and they paid in, and they got a check for $1,000 for, I don't know what kind of property they had. Say, oh, I had to pay this check. One check disqualified the whole plan. And we fought for more than a year with the IRS to get them out of it. They wanted to literally, absolutely close the account. Everything was premature. The penalties were ridiculous. You don't want to get into that. So make sure you work with a qualified company that really goes over the prohibited transactions and prohibited disqualified people. So that is my caution to you. Make sure you understand if you have a relationship with your tax strategy and your CPA, make sure you have those conversations as well, that you understand before you get into trouble. Another one is fraudulent crypto advisor and promoters. There are a couple of different ways to really vet professionals. Now, sometimes you can't, right? But make sure you do your due diligence. I cannot recommend this enough. If it's a CPA, the CPAs are listed. We're all public record. If it's an account, if it's a tax attorney, they're all like, you can verify them. Fiduciary custodian, make sure you have all of this. Make sure you have the agreements in place. Use somebody who's certified, because they will protect. Like, we will not say something, will not do something to jeopardize our licenses. So because of that, you want to make sure you use qualified people, and advisors in your, on your journey. Right. And I think I alluded to this a couple of times. How do you protect your wealth, and what do you need to do? Make sure they use multi-signature wallets for business accounts. And I think Eric and James, both of them talked about this a little bit. And the sequence, I think James talked a little more in depth on, kind of the tier of, signatures that you have on each one of the accounts. So you can go and get informed, right? Subscribe to the people that are giving you valuable information. How do I protect myself? Transfer large holdings to cold storage. Again, what does cold storage mean? Go and make sure that you're educated and you understand how do I protect my money, right? The same way you would go into a bank account and say, is this FDIC insured or not? Many people, when some banks collapse, they're like, oh no, oh shoot, am I protected? They have no idea. So make sure you do your homework before you put your money in it, before you invest. Vet your exchange, custodian, CPA as the IRA provider. So we only bring people that are already vetted. So you have here amazing professionals that will sit down with you and will help you get to the best place and make sure that you're educated. So use people, and if you use somebody else, make sure you do due diligence, right? Avoid platforms promising unrealistic returns. Right. We talked about the scams, the Ponzi schemes, the fake wallets, all the in-betweens. Now, here's where a lot of people don't like this. Keep detailed documentation on transactions, ownership, transfers. Like, even if it's a Google Doc, even if it's a document, even if it's on paper, it doesn't matter what you do, but just make sure you keep documentation. And I'll tell you stories. Like, a person can pass away in like this. Like, you can have a massive heart attack and you're done. And if you are the only one who knows all of these pieces of information, you can have your trust, you can have all of that. If none of it was recorded anywhere, who would know? And I don't want to scare you to that, but I want you to know that keeping that documentation in place, it saves not only you, but it saves your family if something is to happen, right? And also schedule periodic reviews with your tax strategist and cybersecurity expert. Make sure that you have all those things covered so you and your portfolio is protected. I hope this is helpful. Again, keep in mind that Bitcoin is opening a door right now and I think James said it so beautifully in the beginning that, people were scared, like, oh, what is this Bitcoin? What is this crypto? And the business owners like, well, I have a business to run. I don't really care about crypto. I don't care about Bitcoin. What I really encourage you to do is, if you are thinking that, hey, this has been on the news long enough, if the Treasury is talking about it, if there's all these people going and getting on it, maybe it's time for me to really get on and understand a little bit of what's happening. And I'll leave you with one of the quotes that I absolutely love from one of my mentors. If you only expose yourself to what you agree with, you are in the danger zone. You might not agree with Bitcoin. You might not agree. You might not like it. It doesn't go away. So if you're thinking and the fear of missing out on something that could become much greater than we anticipate, I encourage you to really open your mind to learn what do you need to know to invest and add this to your portfolio, right? For you, your generational wealth, for your kids, right? I hope this is helpful. And I want to bring everybody else for the questions and answers. And I hope this is really good for all of you and you can take something and learn. Let's see if we can get the Q&A session started. Thank you all. Let's see, we have Eric and Corey. Cynthia, you raised your hand. Let's see if we can get Cynthia. Yeah, Cynthia, you can unmute.
Okay, so I didn't mean to raise my hand, but I do have a lot of questions here. So I can just fire them off, or you can read them, whatever you want to do. How do you want to start this?
You can start with a couple of them.
Eric, let me pin you too. Are you still here?
I'm here.
Pin him too? Laura, can you work on putting him on the screen? All right, I'm just going to start. I'm going to start at the top, and I kept a little file. So what is the cost, Eric? This one's for Eric, to mine on a solo miner like you have in your home?
Yeah, so the costs, first of all, I don't have an incentive to promote them, but I would use BitX Solo Satoshi. It's at solosatoshi.com. Great team here in Texas, just 4 guys working in their living room. The units are great. They're about $180 for the unit, $20 for the stand, and my electrical costs have gone up about $2.50 to $3 per month per unit. So it's very inexpensive. But again, Lowest probability of mining a block. It does happen. It has happened frequently, but about $180, $200 to get started up, and about $2 or $3 a month in energy cost.
Okay. I'm going to try and round robin these and pick one from each sort of category. So Corey, can you roll over an HSA if you're still contributing to it? Is that a Corey question? Yeah.
If you're still contributing to an HSA, you could either open like a sub HSA account with an administrator that allows you to self-direct, or move that entire HSA over. Basically, the HSA is sponsored by or allowable per your high deductible health policy. So either way, it would typically work out for someone.
Okay. Laura, if my estate is below the estate tax exemption, should I allow appreciated assets to pass to my heirs to allow the step up in basis versus gift during lifetime?
That's a great question. It all depends, right? So if you're passing appreciated assets, you have to keep in mind that you're limited to the 19,000 a year per person. So you're not going to be able to gift, a piece of real estate, right? So the appreciation in basis is really good when you are obviously below the estate tax exemption, but it works for larger assets, right? This is something that you don't have great appreciation now, but you could appreciate later on, right? So, again, you have to weigh the pros and cons. I would use both, right? If I have real estate, I would probably do step up in basis. I would not pass real estate. But can I do different types of stocks, different types of, digital currency? I probably would. Yeah. Yeah,
Okay.
such a great question. It all depends. It all depends what do you have and, how will the kids use it? Yeah.
Okay. Eric, DCA to BTC, what does that mean?
First, I'm going to inject some comedy in this. I find it funny that the Bitcoin guy is wearing the suit and collar, and the financial institution guy looks like a Bitcoiner. I spend about 90% of my life in a hoodie, so I put this on for you guys today to look special. DCA it's dollar cost averaging to Bitcoin. So dollar cost averaging works in two directions. With traditional Bitcoin, you can just I started buying 3 cryptos. I ended up going fully onto Bitcoin in about 4 months. But I just set up an auto draft. So every Friday, I would put $50, $25 into a cryptocurrency and kind of watch the market as I learned. I call Bitcoin mining investments reverse dollar cost averaging, because I'm putting a lump sum in at a certain price, and our fund itself pays in Bitcoin. So we don't sell the Bitcoin and distribute monthly distributions in cash. We distribute in Bitcoin to a multi-sig wallet that we set up for you. So it kind of goes both directions. You can either take a small amount and invest it slowly over time, or put a lump sum in and then get Bitcoin distributed back out to you. So Bitcoin mining investments done right. I've invested in a few of them early on, like hosting deals and expensive ones that didn't work out. But they were selling the Bitcoin and distributing cash, which was counterproductive. So we distribute in Bitcoin every month to our investors. And make sure you're set up with multi-sig. I would highly advise multi-sig storage for everyone, even if it's personal. All of mine is stored at Unchained Capital. It's fantastic. Think of like a safe deposit box where you need 2 keys to withdraw. That's what multi-signature is. You need either both of your keys, and you don't hold Bitcoin. I actually have these so you guys can see it. I carry these with me. So this is my cold wallet. So this is the keys to the car. So I need this, and I need a white one that my wife has in another safe in another location. I need both of these to actually sell or withdraw Bitcoin from my cold storage. And if I lose one of these, the best part about multi-sig is I can keep these in my safe with the password written down next to it. As long as they're not both in there, you can't steal my Bitcoin. So if you have that there, you can steal this thing with my key phrase and try to withdraw it. I'm going to get an alert from my multi-sig provider. He's going to tell me that's happening, cancel that key, send me a new one, and then I'm up and running. And if I lose one and I need to withdraw, they're the third signing option. So I just do a video, like a hostage video. They know it's me, and they can sign off on the second signature for me. Very safe, very secure.
Okay, so that segues into a really great question for Corey. Who holds the keys for self-directed IRAs that include crypto?
It would be the client account holder. So
Okay.
they would typically, through ownership specifically in that LLC, hold that key directly at their own discretion.
Okay. I'm looking for tax questions, Laura. Okay. What about using an installment sale to a trust to defer taxes to sell real estate or a business to defer capital gains taxes, and then having the trust invest in crypto or other investments with all of the equity?
Yeah, that's a loaded question, Todd. And trust is a completely separate topic. We can talk about it because the trust, again, if it's a revocable trust, like a living trust, it doesn't do anything. And a lot of people have a lot of misconceptions saying, oh, all my investments are in a trust. And just to really make it really, really simple, a living trust does not exist when you're alive. It's just a veil, like a transparent veil that sits on top of everything that you own. So, when we talk about the living trust, that only takes shape and comes to life when you pass. Irrevocable trust, on the other hand, it's almost like a separate company. So it takes shape the minute that you get it set up, you get an EIN, you file tax returns. So irrevocable trusts are separate. On the irrevocable, so you said irrevocable trust. Let's go back. So if you make the investment in irrevocable trust, that works great. Can you do that? Absolutely. Just keep in mind that irrevocable trust is outside of your estate. So that's when you're building that legacy. And the idea is to just compound. Like, can you do mining in an irrevocable trust? Absolutely. Can you invest in crypto and all of, like, you can have multiple strategies? Absolutely. Again, irrevocable trust, the tax rate is really high. So I typically do not, like, unless you have your net worth, if you're a married couple, it has to be over 30 million to really make sense to kind of bring it on the scene and start building all your assets within a irrevocable trust, right? Because you have to distribute to beneficiaries. Otherwise, the tax is really ridiculously high for irrevocable trusts. If you're not in that arena, I really recommend using other LLC structures to really maximize your investments before you go to irrevocable trust. But again, there's so many variations they could go in. There's so many different types of trusts that we use, right? It could be a defective grantor trust. There's so many other trusts that we would use in a tax strategy to really make the most for you. But it all depends what you're trying to achieve. So your goal will dictate the strategy. Absolutely. Great question, Todd.
Okay. Get back to my list here. So, one question I think you answered, Corey. Advanta does not set up the LLC. You can totally DIY the setup of an LLC. Is that correct?
Correct. Yeah. So client has their own discretion. We cannot set up the LLC because that would technically constitute legal advice or legal counsel. So based on being a fully self-directed administrator, our compliant will not let us do that. But it's very simple. We put out tons of educational webinars and content on how to really accomplish that yourself. Or a client could go to their own CPA or attorney to have it set up. They typically charge $300 to $500 or so. One thing, it kind of is a caveat to that question that I saw a few people ask and wanted to expand upon real quickly as well. The solo 401k plan does not inherently need to have an LLC within it to do this type of investing. At least on our end, we offer 3 different levels of our solo 401k. There's what's called a DYO, or a do your own solo 401k. That account, without establishing an LLC, effectively serves as the same purpose. You go open the bank account, just as I described earlier, in the name of the LLC, directly in the name of the 401k plan, and that is effectively your LLC by way of just the ownership and control of the 401k plan itself. Above and beyond that, we offer a standard and an enhanced record keeping solo K, depending on if you want that client account manager to be able to help you, and if you want us to help you differentiate your traditional and your Roth dollars within a 401k, which is allowed. So I didn't get on that either earlier. I wasn't trying to get too technical or too niche with some things, but your 401k plan can hold tax deferred and post-tax dollars within it. It's just a little bit more bookkeeping and record keeping someone would have to do. So I saw that question come up about needing an LLC if you have a solo 401k plan. Not necessarily. Above and beyond our DYO account, there's other products out there that offer similar services.
Okay. Is Bitcoin hackable, Eric?
The network, no. The network is not hackable. People have been trying for well over a decade. Early on, it was when hash was there. That's why kind of these other proof of work networks are not really robust anymore or valuable. Their hash rate's much lower, so it is possible. I mean, anything's possible, but they've been attempting for years. Bitcoin is hackable in the way that people think about their possession or ownership of Bitcoin when it's on an exchange. Exchanges are very hackable. In fact, there was Mt. Gox was a very large Bitcoin exchange that was hacked, and 500,000 Bitcoin were stolen and now recovered and being dispersed back to some of the investors. So if it's on an exchange, it's hackable. If it's in a hot wallet, it's hackable. If it's in cold storage and you do it properly, I don't want to say nothing. Everything is hackable. There is no absolute zero in hackability. But Bitcoin is the safest and most secure network on the planet as we speak. And it's only growing stronger. Our hash rate actually went up to almost 800 exahash while we were talking. So the network is getting stronger as we move along. But get it off of exchanges, just like Laura was saying, which you did a great job on that. Is make sure you get it off of exchanges. If it's not a tradable asset, if it's something you're holding for a long time, get it into cold storage, and it becomes much more difficult to steal.
Okay. Laura, can you take a look at the Q&A and just see if there are any questions in there that...
Yeah, I'll pick up. There's
Okay,
a question here. Larry said, Laura, you mentioned to be cautious on really high returns and almost unbelievable expectations. So James showed us that Bitcoin returns are just that, unbelievable. Why invest in Bitcoin versus the real estate products that that produce consistent high returns over time that are proven? So again, nobody's saying not invest in real estate. And I think Aaron and I had a conversation about gold like a little while ago. It doesn't mean just ditch everything else. Nobody's saying don't do it. Bitcoin returns are different than, buying a business, than buying gold, buying silver, doing like investing in oil, investing, like it's just a different type of asset. So when you look at the returns, like you're looking at an average across the board, right? And you're looking at somebody that offers much more. We have so many individuals in jail, right? That were promising things that just didn't come to be. And you just have to be cautious of something that is outside the norm. Now, the whole digital currency, it's outside the norm. Like it just doesn't follow the fiat currency. It doesn't, like you can't beat, you can't compare, Bitcoin, with Forex, right? So it's not a legitimate comparison. So when you look at this, Bitcoin itself has a separate trajectory, and you just have to look at that trajectory and look at the people and the track records. I'm not saying don't invest. I don't say ditch real estate. If you look at it, would be really interesting. I'm waiting for a statistic, and I'm looking for, if somebody would come up with a statistic, and probably it's too soon to see. We have statistics on based on different levels of wealth. How is the asset allocation in their wealth? And real estate is really, really high percentage for the people that have 10 million, or I think 10 to 50 million and less. Real estate is the top category in the asset allocation. If you go to people that cross that 50 million mark in wealth, what happens is it's a huge shift into business interest. They have companies, they have other types of investments. So I don't know yet. I think Bitcoin itself is not big enough to give us a statistical view overall, like how is the asset allocated. But I'll be curious to see. I think in a couple of years, we'll see something, how different people at different, values or net worth value, they will have a shift in Bitcoin or other digital currency. Bitcoin is the top that we're talking about versus real estate, versus business investments, the stock market and all the other ones. So I'm not saying don't invest. Again, we're just looking, we're the people who get to see all the back end when something works out really well and something doesn't work out. We file all the Ponzi schemes for people that invest and they just didn't come to life. So that's my word of caution, that, hey, you want to make sure that you do that due diligence. That's all I'm saying. I'm not saying ditch the real estate, maybe not this year, but maybe this year.
Can I add to that a little bit?
Yes, absolutely.
So right now, BlackRock is recommending a 1 to 3% allocation of a portfolio into Bitcoin. That's kind of standard. So there are maximalists who have 100% of their net worth in Bitcoin, and they're great. I am not. I'm not at that stage. I've been telling people for 5 years, and Cynthia will know, in this coming season of economics, or 3 years, gold, silver, Bitcoin, raw land, oil and gas investments. That has been my portfolio. So it's not fully Bitcoin. But Bitcoin and real estate is an interesting comparison. I'm sitting in one. So I'm in my guest room right now, our little studio. And in this home, If I were to buy this home in Bitcoin in 2020 when I purchased it, it would have cost me about 44 or 45 Bitcoin. It has almost doubled in value, and today it would cost me 10 Bitcoin. So you want to be able to have that deflationary percentage, like James was talking about, the 1%, 5%, 10% allocation. So real estate's still fantastic. I actually have a plan for some of the Bitcoin I own, where eventually I will use 1 or 2 Bitcoin to buy investment properties. So it's just another way to add balance to your portfolio that doesn't exist.
Yeah, and Eric, I think that answers there's some questions. If Bitcoin is so good, why don't you put all your money there? Because you don't want to put all your eggs in one basket. The same thing. There's always an allocation, and there's a smart allocation. The same way, back in the day, like everybody was investing, US market was probably the only market that you want to invest in. Now we're so global. Like even though like you're not saying one is better than the other, you're investing in the global markets, right? Even if you go, in stocks and bonds, you're going overseas, you're going to European markets, you go to Asia, you go to other places to really leverage your dollar. It's really all about leverage, which I think answers the question. Yeah.
And the
We
more
have
you
some
learn,
other
the more
questions.
you allocate, by the way. So like I started out with less than 1%, and I don't even know my exact percentage of my true portfolio, but I'm over 50% in Bitcoin. So the more you learn, the more you get convicted. It is a process.
Yeah, I agree. Cynthia, do you have, or I'll take, there's some very specific questions. I think probably Eric for you. How might digital gold, like Perth, Mint Digital Gold, or others, who can assign 1 bar of gold to a single owner to prevent the multiple claims of the past on that single bar of gold through blockchain and perfect record of title to be a threat or complement to BTC. I don't even know what that means. So I don't know if you know what that means.
I
It says
do, yeah.
yeah, it says seems like using technology, the gold can sit in a mine or be held and also utilize similar properties of immutability, divisibility, portability with these features down to a speck of gold on that same bar.
Yeah, what the question is really talking about is tokenization of real world assets. So it's assigning a token value to a bar of gold or an ounce of gold. There have been at least 15 of these attempts that I've seen in the past that they're good projects, they're worthy projects. We're a little bit a ways away from actual standardization, regulation, and laws behind these things. You got to remember the one thing that Bitcoin removes that every other investment requires is trust. So I have to trust that Perth, who I own gold from Perth. So don't get me wrong, I think they're a great company, but I have to trust that Perth will honor that obligation to that digital token on a blockchain. Bitcoin is completely trustless. It is an immutable protocol. So it does exactly what it's supposed to do every single day, day in and day out, and doesn't require trusting any human beings. Tokenized real world assets is a very hot topic right now. But at the same time, I have to trust someone in a foreign country that the token I hold in my hot wallet or cold wallet is actually tokenized to that bar of gold. So until there's clear regulation and oversight to that industry, I remain very hesitant on it. I'm excited for it. I think it's an exciting thing. I think there's many inherent dangers that the promoters don't talk about. And one of them is being, I have to trust that someone in a foreign country is going to honor my obligation of ownership of that gold at some point in time.
Yeah. I think this question would be for Corey. There's some various questions on the solo 401ks. It says, if I have a solo 401k, isn't that effectively an IRA LLC?
Yeah, that was the question I addressed in my last answer. It can be effectively if you're on what our product is, the DYO Solo 401k, or there's other products out there like the EQRP and various things that other providers offer. But that LLC, or I'm sorry, 401k structure is basically leasing a 401k plan document from a provider like us and serving as your own trustee and administrator for your own 401k plan. So that definitely works. It's not the best way for every investor because a lot of investors do want to have that client account manager and the custodial services that we offer as companies, throughout the industry. But it does effectively give you the option to serve as your own trustee, administrator, and have checkbook control without even having to establish an LLC.
Yeah, that's great. So there's a really quick question here. How do I invest a small amount if I'm not going to do mining?
In Bitcoin, if you're not going to do mining, if you wanted to mine, again, I'd go with a solo miner. They're $200. You set them up. You may not ever hit anything. You may hit a full block. You don't know. But you get to contribute to the network and understand decentralization. That's really a big. Once you understand decentralization, removing government control, it's pretty exciting. Like we like watching them. I always tell people before you get into mining, if you're new into Bitcoin, start buying Bitcoin. I highly advise for new people putting small amounts in to go to river.com. I have no deal with them as well. But river.com is really good. They're a Bitcoin only exchange. They do multi-sig storage, high security, and they do dollar cost averaging. So it's a really easy place to sign up, put your information in, set up your debit card, credit card, and you can start buying Bitcoin. And then eventually they have a customer service, actual customer service, which doesn't really exist in crypto. But they have a great customer service team that'll help you move it off of the exchange into a cold wallet and do a step-by-step process with you. I think it's free too. So river.com is a great place to start if you're just getting into Bitcoin for small amounts.
Yeah, thank you. And there's another question here. We saw this. I'm not clear how mining is impacting or related to energy.
Yeah, so to mine, you have to have energy. So the mining components are all computer based. So if you're and they're high energy consumption, these are very high computing units. ASICs perform one task, and that's solving the Bitcoin block issue. So energy is related to that because number one, you have to have a solid energy agreement or an energy setup. So like what we're doing, we have two businesses. In one, we have a CO2 byproduct company that provides revenue and taxes, and the other one being the mining sector. So in that area, energy is directly consumed in order to mine Bitcoin, whereas we're kind of used to the fiat world where crypto is very similar to that, where they just push a button and there's 100 billion tokens or 10 trillion tokens and they hand them out and sell them. Bitcoin, you have to earn them by solving complex equations. So when you solve these problems, in order to do that and compete in the space, you have to have high computing power. So that requires massive amounts of energy. And thankfully, Bitcoin miners have been very innovative in this space to be able to find the most effective and efficient ways of getting high amounts of energy for low cost and low environmental impact. And that is really kind of the direct consumption. The Bitcoin network is an energy network. It is a protection layer of energy around your money, which is one of the reasons people consider it very safe and a store of value.
Yeah, that's great. So there are quite a few questions here for you, Corey, how to get a hold of you. If Cynthia, if you have Corey's information to put in the chat. I know Corey had a slide with that. So I don't know if Cynthia, if you have that. There's a lot of questions. How do I make this happen? How do I, yeah. So we have the adventaira.com if you want to go in and reach out so you can get your IRA set up and how all of that works. Just make sure you, yeah. The questions are coming up, so I'm trying to wrap up. I know I'm a minute over, so if I'll just try to answer a couple more questions. In here, it says I've been told that having Bitcoin creates issues with the IRS reporting. No, if you report better than them, it doesn't create issues. So with the IRS, what you want to have is track record. You want to make sure that you prove like everything that you do, you've got to document. So how you protect yourself from the IRS. Every move you make is documented. You have a screenshot, you have this, like you have, all the steps that you make in crypto, what you buy, what you sell, what you exchange. If you're accepting Bitcoin as a method of payment in your business, that's a completely separate conversation because it goes into the exchange and that is a separate conversation on altogether because there's a level of tracking that's a bit higher and you want to make sure that you use proper resources and tools for that, right? But other than that, you just want to keep track. Tracking is your best friend. And there was a question here about, and I'm going to probably paraphrase what you're saying, that you have Bitcoin in your traditional IRA, and it sounds like it would be a smart move to go to a Roth IRA and transfer. Now, when you have traditional tax-deferred accounts, every time you move it to a Roth, that is a taxable event. So the Roth IRA conversions have a hard deadline of 12/31. So if you're thinking this year would be a low year in income and you want to transfer some money from a traditional to a Roth, now it could be self-directed and not self-directed, right? So all those moves are permissible. like you are okay to make those moves. You just want to make sure that if you're transferring from a tax deferred, anything that you got a deduction into a Roth, you will have a taxable event, right? Now, can you keep the same Bitcoin in all of them? That's probably a Corey conversation. So I really do recommend, if you have questions about retirement plans, set up a meeting with Corey and his team to make sure that you go through these questions in a little bit more in depth. If you have questions about mining and how you can make it work, does it make sense for you? Reach out to Eric. So we wanted to make sure that we kind of break this apart and give you the education that you need to have to make sure that you have that confidence to invest and you put your money. Don't just put the money in anything. Just make sure that you talk to people that have done it multiple times, have a good track record, go and do it. Make sure you pair this with your tax strategy, because if you just put the money in and not thinking, how is this going to benefit me long term, you might not have the benefit in the end. So, and I know, I want to say thank you so much. Jim was raising his hand. Jim, can we make this quick? I know we're 4 minutes over. Let's see if I can get Jim. I don't know if it's Jim, one last question. Let's see. I don't know if we can unmute Jim. Okay, I unmuted you, Jim. I'm not sure if we can hear you. Well, I want to say thank you, everyone, for being here. It was a great conversation. I learned so much. So I hope you learned as well. Every time I sit with these amazing people, like I learned something new. And that's the beauty of life, that you don't know it all and you keep learning. And I want to say thank you so much to James, Eric, and Corey. You have been amazing. You have their details. The replay will go out, which you can go back and look at the slides, look at all that. You guys had a lot of questions about the slides. Go and digest this. Make sure you understand and you reach out to the right people to make sure that you fill in the gap that you need. And as I mentioned in the beginning, next week we're going to have another educational event for protecting your assets. So once you're buying and you're diversifying, how do you protect yourself? How do you structure that protection? So please join us next week. If you're a business owner and you're keep diversifying and having assets, make sure that you protect yourself. And again, we're going to have a really great conversation next week. The link is probably in the chat someplace. Cynthia can do that. Thank you so much, everyone. It was a great conversation. Have a good weekend. And if you're mining, go get it. And if you're not mining, let's go and buy something, this weekend, so we can take advantage of the little dip that we have right now. Thank you so much, all. Have a great weekend. Thank you, Eric. Thank you, Corey. Amazing.
Thanks, Laura. Thanks, Cynthia.
Thank you.
Thank you.
Yes. Bye.
Happy investing.